Modest gains in consumer prices leave room for more economic stimulus. PPI drops more than forecast. Plus, the world's biggest chip maker, TSMC, tops estimates, but concerns linger over mounting economic headwinds and tighter US trade controls.
I mean, nothing's really happening, Tom, before that US CPI print, right? That's all we care about. So for the moment, futures are edging up a little bit to 0.2% higher. We start earnings season. That's it. It's like 25 companies a day. We look at UK retailers, but really it's all about inflation in the US.
Yeah, earnings season already upon us. We're going to get Citigroup, Wells Fargo tomorrow. As you say, you're not going to be wanting to take arguably big positions ahead of that CPI and print, the all-important inflation print. The expectations are you're going to get 6.5% year on year for the month of December. So down, of course, from the plus 7% that we got in November. What that tells us then about the rate trajectory for the Federal Reserve. Did they go 25 basis points at the end of Jan, early Feb? And what does it all tell us about that labour market as well, wage prices and the mix around inflation? China inflation, by the way, coming in, as we said in the headlines, CPI, yes, that increased, PPI coming in below expectations. It does give room for monetary policy there to expand and step up officials that support for that economy. The FTSE 100 currently up 0.3%, adding 22 points. Over in France, the CAC 40 posting some decent gains in the first few seconds, up 0.3%. The context, of course, was a decent close yesterday on Wall Street, and the Spanish IBEX adding 13 points. Let's switch it over then and have a look at how things are squaring up. As to the futures stateside, S&P futures, S&P E-minis then 3,988, still, of course, holding up above that 3,900 level, seen as key. A range bound again ahead of that inflation print. Euro dollar 107, not all the movement for the single currency, tied, of course, to the machinations of the dollar. 351 on your benchmark 10-year. That's just a move of 2 basis points. And if you're looking for assets that are moving and have been moving, Bitcoin and Ether certainly amongst the mix. 18,000 then, holding above 18,000. 9 straight days of gains. That's the best performance, the best stretch, at least, since about 2020, pandemic times. Gains of 3% in the session today for the cryptocurrency. Francine.
Let's get over to our Bloomberg MLive managing editor, Mark Cudmore. Mark, I know you're looking at CPI in the US, but just because everyone's doing that, you're an outlier. You want to look at UK manufacturing and GDP forecasts.
Yes, absolutely, Fran. You know how difficult I am. Everyone else is talking about CPI today, so I'm going to leave them to it. Much smarter than me anyway. It's easier to shine when you've got no competition in the space. So that's why I'm looking at the UK. And also we're getting those retail updates. If you look at UK manufacturing PMI, it's considered a good kind of lead indicator for the UK economy. Now, as of a few months ago, it fell below the 50 line of the diffusion index, which normally applies. If it stays below there, goes much below there, it suggests a recession is on the way in the UK. And that kind of fits with the very much the consensus that the UK is probably already in recession. I think most people now think that, or at least if it's not, it will be this year. Not much of a debate there. And the track record of the last few years is pretty good. You can see this is the pandemic. The only other time it was below 50. Of course, we had a brief recession and it bounced back very positively. One thing I want to draw attention to, though, is the next chart, which is the consensus forecast for 2023 GDP in the UK and the evolution of that over the past year. Now, you can see that back around September, around when that UK PMI was going into below 50, it became the consensus that the UK was going to have a full year contraction in GDP in 2023. And that kind of negativity has been deepening as we go into Christmas. Something interesting is starting to happen. Now, I might be a bit early on this, but since mid-December, we've had a little tick-up. Now, the smallest possible of tick-ups, but I do think it's interesting. I think that given that energy prices have collapsed so much, and it doesn't look like we're going to have the intense energy squeeze and blackouts that were seen as a possibility a couple of months ago, there's a chance that we have passed peak pessimism on the UK economy. Now, this is not to say that 2023 is going to be good and wonderful and easy in the UK. It's still going to be a very tough year. It's just that relative to the narrative, relative to the gloom, relative to the pessimism, it might surprise a little bit positively from here going forward. At least that's the hope.
Okay. I love that story. Thank you so much, Mark. We need a little bit of glimmer and hope. I think we're also expecting a speech from the London mayor saying that there's been immense Brexit damage to the city. Our MLive managing editor, Mark Cudmore, always shining. Now, stocks are broadly higher today as markets await key CPI data out of the U.S. a little bit later. At 1:30 p.m. UK time is when we get the data, and economists expect inflation to have slowed in the world's largest economy. Well, joining us now is Grace Peters, head of investment strategy for MEA at JP Morgan Private Bank. Grace, thank you for joining us. I mean, if you look at that inflation print, it's meant to be like 0.1 percentage points lower than last month. It's too early to cry victory.
Well, I don't know. One data point doesn't make a trend, but three does. And remember, we've already had 2 CPI prints that have come in below consensus expectations. So our view is that you're going to get the headline CPI at 6.5, which is in line with the street. And the market narrative has shifted. I think to Mark's point, the market really buying into this notion that peak pessimism was probably around October time, when we were worried about China, we were worried about Europe through the winter, and obviously this very well-flagged recession. So I think when it comes to market pricing, the most disruptive outcome would be a higher CPI print, because the market has moved to this expectation that we're firmly in the disinflationary phase, and you've seen risk assets obviously react accordingly.
And significantly above 6.5%, to your point, may lead to a reassessment of 50 basis points, whether that is in February or over 2 sessions from the Fed. What is your view on how far the Fed goes now, and whether the sequencing is what's important here, or ultimately the terminal rate in terms of how markets are pricing this?
Yeah, so I think that so the CPI is going to determine the debate as to whether it's 25 or 50 basis points. We're currently in 25, and then that high hold. So I think that CPI will be important. In terms of the sequencing, then I think the terminal rate is obviously key, call it around 5%, but potential for the market to push higher on that. The other thing that I think is very important is how long it stays at that terminal rate. And that's where the market's been pushing back on the Fed. The market's been saying, I'm tracking the data, and the data is saying that the combination of disinflation and signs of the economy weakening, more headlines around companies, particularly tech companies, laying off staff, and the chance that the unemployment rate may rise as we go through the year. The market's saying, I'm following the data, and I'm calling your bluff a little bit. I'm going to price in some cuts at the end of this year. And I do think the more important thing now is actually how long rates stay high, rather than necessarily where the terminal rate is.
So Grace, overall, I mean, given all of that, are you expecting the S&P, for example, to increase by year end with a lot of volatility in between, or be down?
No, we are expecting modest increases in the S&P by year end, probably for that to be second half weighted, driven by the notion that we are in this phase of disinflation, that we think that you're going to get a recession, a mild recession in the US, Europe, and the UK, but that it's going to come with, call it a 10% drawdown in corporate profits, which is manageable, and certainly manageable versus where we were at that point of peak pessimism back in October. And so therefore, the combination of the market looking forward, when will the Fed ultimately start to cut and support growth, given it doesn't need to focus on inflation as much, that does lend itself, we think, to a slightly higher equity market through the balance of this year.
And what is the regional breakdown then? Because Europe outperforming since about the end of September, up about 16%, S&P up about 11% over the same time frame. Does that outperformance continue? There is a view, the sentiment around Europe has changed pretty radically.
It really has changed, and I think there's 2 key factors underscoring that. The first is the gas storage levels, the way that's been handled in Europe, the fact that we came into the winter with high levels of gas storage. Thankfully, it's been a mild winter, but that does set up a much better outlook for next winter as well, when it comes to how much gas you have to replenish. The second thing is obviously China reopening, that helps Europe. And I think bigger picture than that, we went through 2022 really demarked this huge regime shift from a world of ultra low rates to a world where there is a cost of capital and valuation matters. And within that high-level overview, Europe looks attractively valued. It's at a 30% discount to the S&P. That's a record low. So despite recent outperformance, I think that can continue. So that would be an area that we would be looking to allocate more to through 2023.
Is it region, so it's region specific, but is it country specific as well, as there are various degrees of government support for the cost of living crisis?
Yes, absolutely. So at the moment, our overweight lies in France. We like the CAC 40 because of the sector composition, as you say, and some of the economic dynamics there as well. The UK to us is looking increasingly interesting. I would differentiate. I mean the FTSE 100 rather than the FTSE 250. So we're not necessarily gearing into the UK domestic economy, but more the international exposures. But really putting a great focus on valuations. You know, back to the comments about the regime shift. We don't want to rely on valuations, you know, given the higher rate environment. So we're looking for shareholder returns and where we can have consistent profit growth to drive that total.
Domestic UK small caps would be a brave call, wouldn't it, at this point? Grace, you're staying with us. Thank you very much indeed. Overweight French equities. Maybe that ties into the China theme as well, particularly given the luxury component within French equities. Grace Peters, of course, Head of Investment Strategy for EMEA at JP Morgan Private Bank. We'll get more of Grace's calls in the coming minutes. Coming up, bucking the trend, TSMC profit. Well, it tops estimates, even as the chip industry cools. We'll get more on the details next and the broader implications for semiconductors. Stay with us. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Welcome back to the Open, everyone. 12 minutes into the European trading day. For the moment, you look at stocks and they're actually edging higher, but it really all is about that inflation print over the U.S. and, of course, whether that means that traders will reduce their pressure for aggressive rate hikes from the Federal Reserve, which are currently, well, not 100% priced in European stocks, gaining 0.3%, Tom.
Yeah, and within that basket, European tech currently down 0.5% as a sector. And that ties us to the TSMC story. They have predicted sales below analysts' estimates and said the company will reduce spending. That's as the chip industry braces, of course, for that potential recession and tighter US trade controls as it pertains to China, of course. That's after the world's biggest contract manufacturer of chips reported rising net income ahead of estimates in the latest quarter. For more, we're joined by Bloomberg Opinion's Tim Colburn. And Tim, I know you were monitoring the executive call as well, the analyst call on the back of these earnings. It looks like TSMC believes its size and scale are going to help it kind of in this tougher environment. But they are seeing a bit of a modest downturn in terms of that demand from customers. How realistic is it, do you think, that they can weather this storm?
Well, it was a jam-packed investor conference call that just ended, and they are very confident. In fact, as they pointed out, the chip industry is very, very cyclical. It goes through these peaks and troughs, and when things are good, they're very good. When they're bad, they're very bad. But you know what we're seeing for 2023 is the slump is not so bad. Now, admittedly, first quarter was coming out worse than expected. It's just a forecast, worse than analysts had expected. But they're very positive on the second half. And so on a net-net basis through the whole year, we're going to see some growth for TSMC this year. Now, in previous downturns, we tend to see some pretty deep drops, up to sometimes double-digit drops in revenue year on year. So the fact they're going to come out even with a little bit of growth is good. The reason there is AI is going to be a big driver of revenue this year. They did hint that some big customers in the second half of the year will have some new chips. They didn't name them.
All right,
but I will point out that both NVIDIA and AMD are their clients.
Tim, let me just jump in because I think we're having a slight audio issue, so we'll try and get it fixed and get back to you. Bloomberg Opinion's Tim Colburn there, of course, on some of the chip makers and some of the supply chain issues that we've dealt with. Still with us, Grace Peters, have investment strategy for MEA at JP Morgan Private Bank. Grace, overall, when you look at chips, when you look at just the supply chains, how much more of these supply chains still need to be readjusted, and what does it mean with the reopening of China?
I think when we think about COVID impacts, much of the readjustment and the rehabilitation of supply chains has actually happened. It's dramatically improved. It's one of the factors that's helped drive down goods inflation. But I think there's a structural story here as well. When we think about the lasting impact of COVID and specifically these greater geopolitical risks in Europe and around the world that also featured in 2022, then there's going to be lasting implications. These problems need to be solved for, and that means some supply chain reorientation. Obviously, bigger picture, we've also got decarbonisation, which is heavily reliant on semis and chips. And so there is a structural story here as well. So when we're looking at this quarter's earnings, and just like it's a well-flagged recession, you know, consensus are expecting quite a negative quarter of earnings, but we're actually hoping to use some of that weakness to actually buy into some early cycle sectors, to our earlier conversation about when we transition from late into early cycle demarked by that recession. And some sectors that we think will do well through the next cycle and could lead the market through the next cycle. And semis and industrials would be in that group.
So semis and industrials part of that group. So just unpack that a little bit in terms of the opportunities you're looking for. You flagged a couple there. Where is the resilience?
So right now, I think the resilience in markets, typically as you go into a downturn, it's in healthcare. That would be a classic sector that actually is.
Healthcare?
Yeah, so when you look at it on a valuation basis, healthcare outperformed last year. So earnings resilience, yes. Valuation, question mark. Actually, it's in line with the market, which is not too bad for a defensive sector. It's better than other defensive sectors, perhaps like staples and utilities in terms of valuation, but it's a good place to hide for that earnings resilience. So that's classic late cycle. As you want to move into more cyclical early cycle sectors, then banks could be another option. We're just at the start of the provisioning, the loan loss cycle, so I feel that's a little bit early, but that could be a good, classic early cycle sector. But you want to keep an eye that you're not just getting cyclicality, I think. You're also buying into secular growth, and again, that's different, I think, this cycle versus previous.
Grace, what do you do with energy? So I guess the big surprise is actually the energy, I guess compendium in Europe is actually better off now than it was a year ago pre-war. Yes. But I don't know whether some of these energy stocks outperform like they did last year.
Yes, I mean, they were obviously the big winner last year, the energy complex, and within that energy equities. We think that there's more legs, particularly to the European energy names, actually, versus the US energy complex, because they have a few characteristics that we're looking for around strengthened balance sheets over the last few years, therefore the potential to sustainably deliver shareholder returns or share buybacks as well as dividends. And we do think fundamentally that whilst oil is, one of the assets that is cyclical to a growth contraction, that the structural story for oil over the next few years is that oil may remain around $75 to $80 per barrel, which, you know, is actually pretty good for these companies in terms of cash flow generation.
Yeah, $82 a barrel currently on Brent. So the call there to maybe start looking at banks, early cycle, healthcare, possibly an opportunity as well as a late cycle sector. Looking ahead to these earnings. Grace Peters, always fantastic. Thank you very much for coming to the studio for the analysis, of course. Head of Investment Strategy for EMEA at JP Morgan Private Bank. Now, we had some technical issues, ironically, with Tim Colpin over in Taiwan, as we talk tech and TSMC and the questions of chips and the outlook for that company. Let's bring Tim Colpin back because it's such an important story and the linkages, of course, to the semiconductor companies listed here in Europe, whether it's ASML or ST Micro over in France. Tim, just get us up to speed on we had the fourth quarter, it was a beat for the fourth quarter for TSMC, but the first quarter, in terms of the sales forecast, coming in a little bit below what some had expected, but also CapEx and that divergence in terms of where they're putting their money to play in producing additional facilities around Japan and the US, the importance of that trend.
Yeah, I mean, it is ironic we just had technical difficulties. So what we're going to see really in the first quarter is a deeper dip than we might have otherwise expected, but we're going to see a V-shaped recovery into the second half. That's essentially the big takeaway. C.C. Wei, the CEO, said it will not be a U-shaped recovery. And really that's because we're addicted to chips. We need the chips for AI, we need them for computers, all sorts of other things. And so the global economy, despite the downturn, will still be buying a lot of these chips. And you pointed out, they are looking at expanding possibly a second factory in Japan. They're building the first one. And they opened up the idea, or open to the idea, of doing something in Europe that would focus on the automotive industry. But they dropped the hint that they would definitely want government help to get that happening. So some more government money might be coming in to help TSMC.
But Tim, how long would it take actually to make these changes? Are we talking like 2 years, 5 years, or a decade?
Well, from the time that something in Europe would be announced, we'd be talking maybe 3 years, possibly 4 years to get up and running, the first chips coming out of a factory. That's the kind of timeline we're looking at Arizona. Arizona is in process. It's pretty much on schedule, maybe a little bit behind schedule, but we're talking about 3 years from the first movement to the actual chips coming out of the factory. And that would be definitely good for Europe. Japan also in process. We don't know exactly if they would add an extra factory, but these are about 3 to 5 year plans before things get going.
Thank you so much. Our Bloomberg Opinions. Tim Colpin. Now coming up, we'll focus more on Europe, and of course we'll look at what Germany wants to do with some of these bonds.
Yeah, the importance of the German Chancellor, Olaf Scholz, getting on board with potentially some additional support for the industrials, particularly in the renewable space in Europe, as they contend with that Inflation Reduction Act. The tensions there between the US and Europe. We'll get more details on that. Your markets currently in Europe, you're looking at gains of close to 0.5%. Futures in the US, though, pointing down just by 0.1%. Stay with us. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO. I have a problem. I call you up. I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to The Open, everyone. So we're 23 minutes into the European trading day. A lot of updates from a lot of companies. So we have a full roundup, of course, of some of the UK news with retailers. Overall, though, we're really just waiting to see how that US CPI print shapes out. 1:30 UK time later today. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Disney is preparing for a proxy war with activist investor Nelson Peltz, who has nominated himself to the board in what could become a highly public debate over Bob Iger's leadership. Meanwhile, the executive chair of Nike, Mark Parker, will take over as Disney's chairman. He'll advise Iger and the board on finding the CEO's replacement. Bloomberg understands Subway has hired advisors to explore a sale that could value the privately owned sandwich chain at more than $10 billion. The US company is one of the world's largest quick-service restaurant chains with about 37,000 locations in more than 100 countries. Chinese car maker BYD is planning an aggressive expansion in India's electric vehicle market. The company told Bloomberg that it's seeking to capture 40% of India's EV sales by 2030. BYD, which entered India in 2007, will launch its third electric car, the Seal luxury sedan, by Q4 this year. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins in London, thank you very much indeed. Let's check in on some of the stock movers today. Big moves for Halford, Tesco coming in with a miss as well, and ASOS under pressure after the worst performing stock. It was the worst performing stock here in the UK last year, ASOS. Let's start with Halfords then. They have missed in terms of the guidance, down 21% on the back of that news, saying that they have been unable to hire the technicians they need, meaning that they're going to see potentially lower growth. The analysts are not amused by the outlook cut there for Halfords. This is an auto and biking company, of course, in terms of supplies. Tesco, that was a miss on the top line, down 1.6%. ASOS gaining, in fact, despite the miss, up 9% on the back of a four-month sales coming in at 1.34 billion. The estimates have been for 1.38 billion. Revenue down 3%. Again, for the context, this stock was down about 80% over 2022, but a bit of rally in the session this morning. Coming up, China's PPI falls more than expected in December. That's as the sudden end to COVID zero hits factory operations. We've got more on that story, the implications for the global economy. Importantly, what it means for monetary policy. Will the PBOC, will the Finance Ministry be able to step up support for that economy given the inflation dynamics in that country? We'll get the analysis and the details. Stay with us. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
This is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Stocks broadly higher, treasuries are mixed before today's expected deceleration in U.S. inflation. Now, China shares rebound amid optimism that modest gains in consumer prices leave room for more economic stimulus. PPI drops more than forecast. Plus, the world's biggest chip maker, TSMC, beats estimates, but concerns linger over mounting economic headwinds and tighter U.S. trade controls. What are the markets saying?
Well, you've got to hope that this inflation data, for the sake of these markets, is going to come in line or below, because they are squaring up, it seems, for a softer print. Certainly here in Europe, Asian session was positive as well. 9 straight sessions out of 10 in terms of the gains across the MSCI Asia Pacific. Equities bid in Europe this morning, okay, relatively modest, up about 0.5%, but yields coming in across the curve as well. Treasuries and sovereign debt here in Europe. So that's the gains across the benchmark. The DAX in Germany up 32 points, as you can see. And the FTSE 100 rallying 0.6%. Let's switch over and have a look at what is playing out across the sectors then. We're talking about some individual corporate news, some earnings coming through. We've got the banking sector kicking things off on Friday. But across your sectors then, top of the list, real estate gaining 1.2%. Interesting in the context of traders now betting on sub 4.5% in terms of the terminal rate from the Bank of England. It's currently at 3.5%. At the bottom of the list, just one sector in the red, consumer products. Technology also just a modest gain there of 0.1%. That is how things are squaring up ahead again. And that CPI print, the expectations for 6.5% year on year, Francine.
Now, China's factory gate deflation also narrowed last month, even as rising virus infections snarled manufacturing operations. Now, a small uptick in consumer inflation will likely still leave the PBOC room to ease policy and bolster the economy. Now, that will have implications for global growth as well as the price of oil.
Our current forecast is 90 for 1Q, and we think that the reopening gains momentum when you get into 2Q to 95. Now, because this is a faster than expected reopening, you add $5 more to that 95 to get you to the 100. And if we see those international aircraft get back into the sky and we see people going out of China and back in China, throw another $5 and you're to up to 110 by third quarter.
Well, we're now joined by emerging market strategist at NatWest Markets, Mark Daly. Thank you so much for joining us. If you look at emerging markets, I mean, it's all to do with dollar. What does dollar do from now until the end of the year?
Yes, so we do think we're in the start of a dollar downtrend, and we see this as a really positive kind of virtuous cycle for emerging markets. Emerging markets assets are cheap, right? They had a very bad year last year, and they offer carry. We've seen very significant hiking cycle across the EM central banking space. You kind of can't fight that carry. So we think, investors have kind of gone long some EM quite strategically, but we think there's a lot more room to go, especially for those high beta, high carry currencies.
Okay, there's a two-sided play to that coming through from China, which is the reopening and the optimism and the positivity that provides for many EM markets. But then there's the inflation question, because presumably the call on softer dollar is on expectations inflation stateside comes down. China, though, could derail that, arguably. Is that a potential risk to that forecast?
I think this is the key question among investors. You know, is China reopening? Is it inflationary or deflationary? Because we are going to get this exodus of kind of built-up saving, this exodus of tourism. And what we would say is that short term, it's inflationary. Long term, it's deflationary. Even if you look at the PMI reports from some of the emerging market countries, yes, we've seen supplier delivery times come down, but that's because of demand compression. They're still reporting, you know, raw material shortages. They're still reporting transport logistic issues, all coming from China. You know, this has been one of the kind of enduring restraints on global supply chains since COVID. And we think, you know, a reopening of China, even just within the regions, will really have positive deflationary forces.
And a lot of the markets, of course, are focusing on the next 6 months for China, maybe the next 12 months. You also, in your top 10 risks, like for this year, look at longer-term risks. And there could be a parallel with Japan.
Yes, absolutely. So kind of the demographic challenges that China faces and slowing growth. And I have to say, you know, even within our forecast, we do think that we're not going to get, you know, this bombastic growth kind of coming out. We do think it is kind of going to be more quality of growth, while we do have more emphasis on those headline growth outturns. But we do think that Chinese policymakers need to focus on kind of picking up consumption demand internally.
So what within the EM basket, which nations within the EM basket are most exposed to the optimistic view on China then?
I mean, definitely from price action, we have seen Thailand be kind of a key beneficiary. And I think that is, you know, your tourism play, that you finally get that recycling of China's current account surplus. You finally get those tourism outflows going to Thailand. I think one of the currencies we're looking at, which could be a good opportunity right now to get into, is Indonesia. You know, arguably they are, you know, as equally a beneficiary of China's tourism outflows, and yet we really haven't seen them rally as much as other EM Asia currencies. So that's certainly something that we're watching for, which could have potential to move. And then obviously your kind of commodity exporters, we think we'll see beneficiaries, and obviously Korea in terms of the semiconductor.
Yeah, Emer, overall, so some flows have started to return to EM, maybe in the second half of last year, or certainly September, October, then we had a bit of a pause. What does this year look like?
Yeah, I still think it's a really positive year for EM. And I think, you know, it's not just kind of the financial implications of a weaker dollar, you know, being able to entice, you know, foreign investors back into EM fixed income. I think it's also the positive factors in terms of inflation. You know, for a lot of emerging market central banks, local currency weakness against the dollar was really a driver of inflationary outturns. I think we're coming to a much more positive environment. EM is under-owned, it's cheap, and it's offering really high carry.
Okay, so that's the positive picture. I've got to throw some pessimism in there. Where is the debt risks most acute across the EM space?
Yeah, I would say, you know, one place we've seen a lot of deterioration is Poland. So Poland has done a lot of off-balance sheet, off-budget debt issuance through basically their state development fund. And even though if you look at headline levels for Polish debt, they're only about 55.7. So arguably there's no debt sustainability issue right now. But I think we have seen a deterioration in credit quality, and also they've increased substantially FX-denominated debt, which obviously kind of brings on the FX kind of market vulnerability right onto the fiscal balance sheet.
But so do you play all of this through currencies, or do you play it through other asset classes?
Yes, I think that's a great one. Obviously, you know, shorting Polish zloty right now is very difficult to do because you're paying a lot of carry. So I'd be looking for trigger events, but, you know, potentially the central bank coming out and advocating a more dovish policy stance to go short, or potentially the local currency bond market. We really saw, you know, a massive sell-off in Polish local currency debt back in October, which was to do about concerns about, you know, big fiscal expansionary plans and just a lack of funding for the government. So I think definitely, you know, any kind of big increased issuance in terms of local currency debt, or any kind of central bank advocating for near-term rate cuts, would see sharp sell-offs there. Okay,
Emer, thank you very much indeed. Potentially on the vulnerability around Poland, but more broadly, the opportunities and optimism around the EM space on the back of a call on softer dollar and the strength coming through from China. Emer Daly, emerging market strategist at NatWest Markets. Thank you very much indeed. Right, coming up, the UK property market is facing a perfect storm with rate rises, inflation, and price drops all weighing on the market. We're going to get an outlook on the sector. That is next. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to the Open, everyone. 41 minutes into the trading session. For the moment, we're getting 0.4% across the board for some of these European stocks. Look, it's all about the U.S. inflation data. Of course, traders wagering that U.S. inflation is cooling, and that would reduce, of course, the, I guess, aggressiveness of rate hikes from the Fed. Will it, won't it? The big question of the day that will move markets across the board.
Yeah, and in your sectors, top of the list, interestingly, is real estate, currently gaining 1.3%. You've had some earnings come through from the likes of Persimmon and others, at least updates on trading. Gilts as well, yields coming in. So that ties into the property story. And it has, of course, been a challenging time for the UK property sector. Inflation, rising interest rates, of course, and a decline in prices all weighing on the market, which is bracing for a pivotal year. So to get some analysis and calls on where house prices go from here is Frances McDonald, Associate Director of the Residential Research Team at Savills. Frances, good morning.
Morning.
Thank you for coming in. Is the worst behind us when it comes to price pressures across UK real estate?
So I think, just to give some context, if you think about what happened during the first 9 months of last year, the housing market remained really strong. And it wasn't until we sort of saw interest rates beginning to rise as a result of that rising inflation in the autumn that we had to, that we begun to see those house prices fall. So we saw prices fall by around 2.4% across the UK during the final quarter of 2022. And we are expecting that those price falls will continue into this year. So we're expecting that prices will be around 10% lower by the end of this year than they are at the moment across the UK as a whole. But I think important to remember that we are expecting some disparity depending on on which region you're in. So markets that are most constrained by affordability, so London and the southeast in particular, will be affected more by those rising interest rates. And so they're expected to fall in value slightly more significantly than perhaps those in the north of England.
So, Francis, at the same time, so we're speaking to our John Stepek, who was saying, look, the possibility of house prices, certainly in London and its neighboring, I guess, counties, the fact that it could fall by 30% is something that at the moment is not base case, but could happen. I mean, do you have any doom and gloom scenarios like that?
So I think our reasonings for being slightly more positive than perhaps that minus 30% figure is down to really three factors. So the first being we're not expecting that unemployment levels will be at the same level that they were that we've seen perhaps in previous downturns. So for example, during the global financial crisis. So that leads us to believe that there will be fewer forced sales coming onto the market, and that limits the level of price falls that we're likely to see. The second being that most people have fixed onto longer-term fixed-term rates in terms of their mortgages. So whilst we will see some people coming off of those fixed terms over the next 18 months or so, there is a degree of cushion in terms of those who have fixed for longer, and they'll be able to kind of ride out that period of higher interest rates. And then the final one being those who have taken out a mortgage since 2014 will have been stress tested at 3 basis points. So when they took out their mortgage, they've already got a bit of an affordability cushion in terms of where they're able to go if they are coming off of that fixed rate in the near term.
So to be clear, Francis, on forced sales, you haven't seen a tick up in forced sales, and you don't forecast a tick up in forced sales. That's not coming through at all.
So I think during any sort of downturn, of course, you will see some degree of forced sales, those people who perhaps have stretched themselves further when taking out that mortgage. But we're just not expecting it to be at the same level that we've seen during previous downturns, given those factors I've touched on.
So who's coming in and buying a lot of these homes? Is it, I don't know whether you have a breakdown of age, but also nationality?
Yes.
Cheap pound maybe means more, investors from abroad.
Yeah, so what we've touched on so far has been, broader mainstream market, but actually the top end of the market, that prime market, is behaving slightly differently. It's performing slightly stronger as a result of being dominated more by equity as opposed to relying on mortgage debt. And you talk about international buyers, so central London in particular, that top end market has benefited from that return of international buyers and the weak pound, as you talked about.
Francis, what would your advice be for first-time buyers looking to get into the property market here in the UK this year?
So I think it's very difficult. It's for different in every scenario, but I think if people are able to buy, it's not necessarily a bad time to buy. We wouldn't necessarily say that. Our 5-year forecast is still for positive growth of around 6%. So we're expecting that those price falls of this year will be recovered by 2026. And so that gives us confidence going forward over the longer term. So if people are able to take that longer term view, then absolutely we would still...
Is that 6% over 5 years or 6% on an annual basis?
6% over 5 years in total by
so pretty modest by comparison.
Absolutely, but if you put that in the context of the price growth that we've seen since the beginning of the pandemic, we've seen growth of around 24% between March 2020 and September of this year, prior to those price falls that began to creep in the autumn of last year.
All right, Francis, thank you so much. Francis McDonald, their Associate Director of the Residential Research Team at Savills. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Advisors to FTX have found more than $5 billion in cash or digital assets that the failed crypto group may be able to sell to help repay creditors. A company lawyer told the judge overseeing the bankruptcy that it's working to monetize assets, including many that lack liquidity. More than 9 million customer accounts have been identified so far. 100,000 civil servants are the latest group to announce UK strike action. Workers for 124 government departments and agencies will walk out on February the 1st, impacting services including driving tests, passport applications and welfare payments. The fresh action over pay comes amid strikes by nurses, ambulance workers, railway staff and others. The UK and Japan have signed a major defence pact which will allow military forces to be deployed to one another's territory. Prime Minister Rishi Sunak and his Japanese counterpart Fumio Kishida reached the agreement in London, which will allow for larger, more complex joint military exercises. It comes as Tokyo expands bilateral cooperation amid concerns about China's rise. US authorities are working to determine what went wrong in an outage that prompted a nationwide flight stoppage yesterday. The Federal Aviation Administration have confirmed an earlier Bloomberg report pinning the likely blame on a damaged database file, saying there's no evidence of a cyber attack. At one point, an estimated 9,000 flights were delayed across the US. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Coming up, could it be a new threat to European manufacturing? Policymakers are calling for measures to counter US green subsidies. We are live in Brussels with details later this hour on this potential geopolitical spat. Stay with us. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. We are 51 minutes into the European trading day. Stocks across Europe currently up 0.5%. A pretty solid session here in the UK. The FTSE 100 trading at 7,764, adding 39 points. And over in France, the CAC 40 is up 0.7%. It is all about that CPI print out of the US later today. The forecast of 6.5%, 6.5% year on year, and what that will tell us about the trajectory of rate hikes. One company we want to pull out for you in terms of the earnings story. Earnings are coming thick and fast at the moment. We have banks, of course, stateside coming out tomorrow. But here in the UK, retailer, on-time retailer ASOS actually rallying despite a miss in terms of its earnings. A key line, I think, coming through, which is that they have identified about £300 million worth of cost cuts. A new chief executive took over in June of last year. So maybe this is a bit of relief from investors that it wasn't worse even worse than it actually came down. But they did struggle in terms of deliveries and, of course, inflation over the Christmas period, but potentially looking at profitability improving in the second half. Francie.
Now let's take a look at what we're watching out for today at 9 a.m. UK time. The ECB releases its consumer expectations survey along with its latest economic bulletin. At 1:30 p.m. we will have, of course, plenty of data from the U.S., including that very, very closely watched CPI reading for December, as well as the initial jobless claim figures. Now later today we'll also hear from a couple of Fed members. The St. Louis Fed President Jim Bullard and Richmond Fed President Thomas Barkin are due to speak, and then later 1:30 a.m. Friday morning UK time we'll have trade figures from China.
Okay, Spain and Germany, they are calling for EU-wide action to boost investments across the bloc in response to Biden's green subsidies. We've seen this anger boiling up in Brussels. Policymakers see parts of the US Inflation Reduction Act, or IRA, as a threat to European manufacturing. For more on the options being considered then in Brussels and the importance of that intervention by Germany, Maria Tadeo joins us from Brussels. Maria, what are the Spanish and Germans calling for?
Well, Tom, first of all, by the way, we should really highlight and stress the start of the year. It's all about the Inflation Reduction Act for the Europeans. This is the #1 concern. I hear this time and time and again. Remember, if you go back to Monday to that interview that I had with the Belgian Prime Minister, he had, well, a lot of straight talk. He said this is the biggest concern for Europe. It is a threat. This Inflation Reduction Act is pulling away investment from Europe, and that reflects kind of the anxiety that is building here on the policy front. And to answer your question, that is why we're seeing now a flurry of proposals from a number of countries. We talked about Germany, but we also had Spain yesterday talking about this idea that there may need a need for more funding to facilitate state aid to prop up European companies in response to this. The interesting thing, of course, is that it may suggest that for the Europeans, well, this idea of a diplomatic solution may not come fast enough, and they now need to come up with their own solution that can counter this plan. Of course, officially behind the scenes, they still say the talks are ongoing. Nobody wants to see a trade war, but it's very indicative that you're already seeing plan Bs being put on the table.
But is that, I know this is like game theory, it's like a chess of very complicated game with maybe 1 million players and 300 bishops, but, you know, are we thinking that there's a diplomatic solution, but there's plan B because that puts pressure on the preferred solution?
Yes, exactly. And you could argue a lot of this are negotiating tactics. Also, Francine, you make a very good point. What we see now is ideas that are being thrown out. We want to see what sticks and what doesn't. Leaks, of course, that at times are very convenient. European leaders themselves are not going to officially meet to talk about this until February. So there's still some weeks to go. That is perhaps a way to exert pressure. But behind the scenes, there's also concerns that for the time being, the United States has not moved far enough, or not certainly the direction that the European Union wanted to see. And again, beyond that, if you look at not just the Inflation Reduction Act, the concern is that the damage that we see from the energy crisis, from all of these issues that Europe had in 2022, could have a lasting, severe impact on the European industry in the medium to long term. And this realization that you cannot be a self-sufficient, powerful continent if you do not have an industry.
And you need energy for that industry. Inflation, as you know, the concerns around inflation, the concerns around recession easing somewhat, at least at the margins for Europe. What does that tell us about their ability for Made in Europe, Maria?
Look, the energy story, Tom, clearly something in the zeitgeist has changed. You could go back to Monday, say a lot of this is that Goldman Sachs note. They dropped that recession call. You also had Deutsche Bank, by the way, say that it's a couple of things together that could be beneficial for the euro. So yes, perhaps the energy could now be a helping hand for Europe, not a counter effect with prices going down.
Maria, thanks so much. Maria Tadeo there with the very latest in Brussels. We'll have plenty more on the markets, CPI, and our Bloomberg UK special. This is Bloomberg.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Now, stocks broadly higher, treasuries mixed before today's expected, of course, deceleration in U.S. inflation. Now, the world's biggest chip maker, TSMC, beats estimates. Concerns linger over mounting economic headwinds and tighter U.S. trade controls. Plus, a less than stellar U.K. picture. Earnings out this morning indicate retailers are concerned economic headwinds will continue to bite. So first thing is first, let's check in on the market. Stocks in Europe are actually gaining. It's all about that U.S. inflation report a little bit later on. Of course, traders now starting to wager some bets that U.S. inflation is cooling, therefore reducing, of course, the pressure for the Fed to hike aggressively. Now, I'm also looking at some of these European stocks because we had a lot of earnings. So we look at retail here in the U.K., higher today in terms of sectors. We have mining and energy. There's also optimism about demand coming from China. European stocks gaining 0.5%, S&P futures pretty much flat, and then sterling 121.37. Join us, of course, for our UK special in half an hour. Now, this is the big story. Maybe let's look at the European map very quickly, but there's not that much of a difference between, for example, Germany gaining some 0.5% and the CAC 40. Now, U.S. inflation data due later today will probably bolster the case for the Fed to keep moderating its tightening pace. Here to discuss all of this, Andrew Balls, Chief Investment Officer of Global Fixed Income at PIMCO. Andrew, thank you for joining us. You have a great report out outlining some of the pitfalls for the next 12 months. How much volatility are you expecting?
Well, we should see lower fixed income volatility compared with last year. There's a lot of uncertainty in the outlook, of course, but the uncertainty over the course for the Fed or for the other global central banks is a lot lower, I think, than the experience of the last year. And across fixed income markets, we expect somewhat lower volatility this year. For equities, I mean, you have the uncertainty over the extent of the recession. Our forecast is for mild recession across countries, but you want to prepare for, be ready for worse outcomes than that. So I think, lower quality, weaker companies, you want to be careful there.
So, Andrew, give me a sense of, are you looking at worst case scenario and best case scenario? And if you look at worst case, what does that look like?
Well, I think, when you have a recession, it's easy to forecast a shallow recession. There's not a lot of imbalances in the private sector. The initial conditions look okay, so the baseline for a shallow recession looks pretty reasonable. But when you start slowing down, it's very hard to know how much you're going to slow down. You know, central banking is a difficult job. They're trying to deliver soft landings, but there's huge amounts of uncertainty in this. But overall, you know, I think it's the pattern in terms of the data. You're seeing the clear slowdown. You're seeing the impact of big tightening in financial conditions that we saw last year, but the underlying imbalances being pretty reasonable give you a reasonable chance of softish landing, if not a soft landing.
Yeah. So, Andrew, very quickly, when you say, you know, there's a strong case for investing in bonds, what are your top 3 plays right now?
Well, I think core bonds look pretty attractive given the starting yields. You had a big repricing last year, so that was painful. But the level of yields looks quite attractive. So, you know, core bond funds or with some more credit orientated funds give you very good, we think, starting yields going into this period of recession. So, you know, keeping it simple and core bonds, and then up in quality in terms of credit and other sectors, maybe EM. There's no reason to be down in quality given the yields available for the higher quality assets. So core bonds look pretty attractive, and we think you can achieve, you know, good returns with assets, IG or US agency mortgages. Say we don't need to go to lower parts of the credit spectrum where you do have you know, more risk in the event of worse than expected macro outcomes.
Yeah. Andrew, let me also bring in Joyce Chang, Chair of Global Research at JP Morgan. We're lucky enough, actually, to have her in London this week. So, Joyce, thank you. You put out this great note, which is actually also quite long-term. So you look at the next decade and some of the pitfalls, and you talk about the great repricing research. What is the most overvalued or thing that, you know, people are getting wrong right now?
Well, first, I just want to say that on the long term, we have had fixed income reprice. And so when we look at 60-40, which had just such a terrible year last year, we're looking at over the next decade, could you get 6.7%? Now, back in 2020, we said that you would only get 3.25% from 60-40. So that's a big change. So with this great repricing, we've had just a boost to future returns. And I think you will see allocations to fixed income coming back here. Yeah. I also think you're going to see more of a rotation into international as well, just when we would take a look at valuations.
So, Joyce, when you look at fixed income, where would you be cautious?
So, look, I think that we've had credit spreads actually tighten faster than what we've seen in the equity market. And so, you know, high yield, we're inside a lot of the targets that we have for the end of the year already. Now, I still like high grade. We're looking at total returns this year that could still be around 8%. 2% excess returns, still a lot of upgrades. But, you know, high yield right now, some of the valuations are looking very tight. And even in EM credit, some of the valuations are looking very tight. So we like local markets better in emerging markets.
And Andrew, I mean, going back to some things that you were saying, how do you play China right now through your space?
So there's a lot of uncertainty there over the reopening and the economic path. I mean, from the global economy perspective, reopening there is, you know, a significant positive, and you've seen the equity market reaction, broader market reactions. I mean, as a tactical position, I think in fixed income space, it makes sense to be underweight government bonds in China. We saw the big repricing of global fixed income last year. We have not seen that in China. You know, it's a market which has a lot of government involvement. So none of these things are certain. But it seems a good prospect that with successful, hopefully, reopening in China, that you'll see them move higher in yields we've seen elsewhere in the world.
So can you actually, Andrew, with conviction say that if we have a CPI print in the U.S. today that's pretty much in line, it means that, you know, amongst the developed markets, the U.S. is definitely leading this kind of, you know, if not deflationary, less inflationary environment?
So you have had good indications in terms of inflation. We should be very wary. No one's won any prizes recently for inflation forecasting, but there are good indications that inflation is moderating. Our forecast is for inflation moderating this year. With the data today and then over the next months, clearly the thing to watch for is the extent to which market expectations for central banks, the sort of terminal points that we have priced in are going to look, more reasonable. Or, the tail risk today and going forward is if we do have higher inflation prints, labour markets remain strong. If central banks are forced to go further, then again, that could be difficult for global asset markets, and particularly we think for the more the lower quality parts of those markets.
So, Joyce, what does that mean? We saw a bit of a rally, right, in U.S., I guess, late into last year. What happens this year?
Yeah, it was a very front-loaded rally. And as I said, that some of the year-end targets we've set, we're already at those targets or inside of those targets. So I think you're going to see some of this U.S. rally fade, and the rest of the world is sort of playing catch-up and some convergence here. And in China, the story is really consumption. Still, I wouldn't underestimate the reopening, even with the high infection rate and some of the concerns. China has basically been shuttered for 3 years, and reopening is going to be a big boost to consumption. Consumption used to be about 4 percentage points of the contribution to GDP, so that still could be a very big uplift. At the same time, there's real disinflation also happening in emerging markets countries.
Yeah, and actually, in your calls, your 3 boldest calls, Joyce, are probably overweight UK and overweight Japan.
Well, look, the UK was the best performer last year. It still has the highest dividend yield. It still has exporters who are benefiting from the weakness of the currency, and the valuations are still there. So we've kept that one on. And where we did not see a front-loaded rally was with the change in yield curve control. We saw Japan really sell off. And as we look across the developed markets, this is a year where Japan looks like it's actually going to outperform most of the developed markets. And if there is an inflation overshoot, the one place that does benefit would actually be Japan. So we do stay with the overweight on Japan here.
And Andrew, what's your take on UK gilts, but also corporates?
Well, look, I think that, we have 2% on the fiscal that is really backloaded, but I do think that, the financial stability concerns that had surfaced, they have gotten those under control. So I am, very comfortable staying with the UK overweight on the equity market.
Okay, and Andrew, what about you in the UK?
Pretty neutral on gilt markets. I think UK residential mortgages, backed securities look quite attractive. So that's something that we have, but fairly neutral on gilts here. The expectations priced in for the Bank of England look pretty reasonable.
All right, so thank you both for joining us. Andrew Balls, Chief Investment Officer of Global Fixed Income at PIMCO. Thank you, of course, with his great report out today. And Joyce Chang, Chair of Global Research at JP Morgan, stays with us. Now, coming up, plenty more to discuss ahead of that U.S. inflation print that's due out later today, 1:30 p.m. UK time. And this is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacroix here in London. Now we're back with Joyce Chang, Chair of Global Research at JP Morgan. Joyce, we're talking a little bit about Fed expectations, inflation. Overall, I mean, there's this dynamic over the last 12 months between the markets and Fed officials where they talk tough, and the markets kind of shrug it off. I mean, is this going to be, once again, the story of 2023?
Yeah, look, I think the markets have to realize that the Fed is not your friend necessarily, and I do think there's two more 25 basis point hikes, and then there is a pause, but there's not a pivot. Yeah. I would call it a high hold, and I think the market has to look at what the Fed is actually communicating to them, and I think that the Fed is concerned that the market performance doesn't necessarily reflect the language that they have been communicating consistently across the governors.
But so why? Why is this happening, Joyce?
I think that just because we've hit the peak of so many of the numbers right now that everybody is talking about the pivot in the marketplace, and I think what the Fed is saying is that even though we've seen the peak, we have some massive disinflation, we're still far away from the target. And the Fed, having not gotten it right as inflation was going up, they can't afford to not get it right, this time. So I think it's a high hold. I think it's a mild recession at the end of this year, but probably the most well-telegraphed recession that we've ever seen. And without the balance sheet, challenges that we've seen during previous slowdowns. So, that's the key message I would have is that, this market already saw a very front-loaded rally. It may see a bit of a pushback. You really have to look at valuations now, and maybe some of the international stuff makes more sense here.
So, but does the labor market hold both in the U.S. and main European countries?
Look, we see an uptick in unemployment, but we're looking at 4.3, 4.4 as we look over the course of the year. I mean, look, a lot of the labor market conditions are structural. It's about immigration policy. It's about the demographics. So I think you will see an uptick in unemployment. What you're going to really see, though, is a drop in the excess savings. So remember that excess savings were over $2 trillion in 2021. Yeah. It's about $800 billion now, and by the second half of the year, that excess savings cushion will be gone. And that's when I think you see the consumers actually begin to take more of a hit. The margin compression will come in. The earnings forecast will have to come down later in the year.
Joyce, what do you do with the energy complex? So this was, the biggest surprise is probably that we're in a better shape, certainly in Europe, with energy and energy reserves than we were back in 2022.
Yeah, and we've also had a very mild winter, which helps as well. So structurally, we still have, a bullish long-term call on the commodities market and this whole deglobalization. But short-term, we do have tactical that, a short energy trade right now, which we'd put on a couple of weeks ago, and that seems to be bearing fruit right now. But if we look at this more longer term, we haven't changed the longer term forecast that we have for Brent. I mean, we're still looking at, $90. We're still looking at, $80 over the medium term as sort of what you need given what the CapEx needs are in the large oil companies.
So amongst, if we look at equities, if you look at the big indices, which one will outperform? Is the S&P going to be, higher than it is now by the end of the year?
I think it will be a bit higher. I mean, we have 4,200 as the target here. So we do see room for the S&P, to go higher over the course of the year. But I do think that, from November onwards, you had a front-loaded rally that hit the credit markets, and the equity markets. So we are a little bit more cautious here. I think the way to play some of this disinflation trade could be through rates coming down in emerging markets and some of the international equities.
So where internationally? I know it's one maybe, some of the equity valuations that look attractive, but you're also expecting, I don't know if it's global or European earnings per share to fall 10% this year.
Yeah, no, we'd rather do the UK over Europe, but I do think there's a China reopening trade that will still play out, particularly in the consumption and the services side. And we have taken up our China growth forecast.
Yeah.
I mean, we still have it below the official target. We have 4.4% growth in China, but I think that you will see a lot of pent-up demand. And the second largest economy in the world reopening is still big news, even if it does fit some setbacks.
Certain sectors, when you talk about retail, is it luxury or elsewhere?
Well, I would say that more of the, like consumer sectors, I think, are going to do better here, just given just what a big percentage of the economy that is. And I also think that in China, some of the housing problems probably peaked. They have more of a strategy now that even though they're still going to have ongoing challenges. So I would still say with more of the consumer sectors in China right now.
I mean, the biggest pitfall is geopolitics, which we still don't really know how to price. And then, of course, volatility. Do you worry about liquidity as well?
Well, I worry about the geopolitics first because, particularly in the United States, Kevin McCarthy finally made it through that whole, Speaker of the House, but he has, said that he will form a select China committee, that there will be talk about more export restrictions, investment restrictions. Could there even be a trip to Taiwan? So I think we have to watch the geopolitics first. The market liquidity has been a challenge across a lot of different markets. I mean, China included, but I mean, look, we saw what happened in the gilts market and even in the treasury market this past year. So that remains an ongoing, I think, chronic concern across a lot of the markets, and emerging markets are less liquid.
Joyce, thank you so much, as always. Joyce Chang there, Chair of Global Research at JP Morgan. Now, coming up later this hour, the UK's winter of discontent deepens. That's as 100,000 civil servants announce strike action next month. Stay with us for more on the UK and politics. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Advisors to FTX have found more than $5 billion in cash or digital assets that the failed crypto group may be able to sell to help repay creditors. A company lawyer told the judge overseeing the bankruptcy that it is working to monetize assets, including many that do lack liquidity. More than 9 million customer accounts have been affected so far. The UK and Japan have signed a major defense pact, which will allow military forces to be deployed to one another's territory. Prime Minister Rishi Sunak and his Japanese counterpart Fumio Kishida reached the agreement here in London, which will allow for larger, more complex joint military exercises. It comes as Tokyo expands bilateral cooperation amid concerns about China's rise. China's factory gate prices fell more than expected in December as the sudden end to COVID-0 held up factory operations. The official PPI fell 0.7% from a year earlier. Economists surveyed by Bloomberg expected a 0.1% drop. Meanwhile, consumer inflation rose to 1.8% in the year to December, and that was in line with expectations. And U.S. authorities are working to determine what went wrong in an outage that prompted a nationwide flight stoppage yesterday. The Federal Aviation Administration have confirmed an earlier Bloomberg report pinning the likely blame on a damaged database file, saying there's no evidence of a cyber attack. At one point, an estimated 9,000 flights were delayed across the U.S. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, stocks are climbing. All eyes, of course, on that U.S. inflation report a little bit later on. Look, what traders are saying is that they're really wagering that the U.S. inflation is cooling, reducing pressure for aggressive rate hikes from the Fed. So we'll have plenty more, of course, on that. Treasuries also creeping higher, adding to gains in U.S. session, while a gauge of dollar strength seems to be little changed as we speak. Investors looking beyond the drumbeat hawkish comments from Fed officials. All right, coming up, but we have our UK special. We delve into the discontent and disruption gripping the UK and how the recovery can be driven by small and medium-sized companies. We'll be speaking to the EMEA president of software group Sage. Stay with us. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Good morning, everyone, and welcome to Bloomberg UK, a new show with a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, on the show this week, the biggest industrial action by the public sector in years. 100,000 civil servants plan to strike next month over wages and inflation, ramping up the pressure on the Prime Minister, Rishi Sunak. Also on the show, retailers are less positive about the year ahead, despite some seeing a sales boost from the Christmas period. We'll break down the latest results. Plus, the EMEA president of software group Sage tells us how small and medium-sized companies will help drive the economic recovery in the UK and what the government can actually do to help. So the strikes roll on. 100,000 UK civil servants plan to walk out next month, adding to existing disputes in healthcare, on the railways, and elsewhere. The action comes as the government plans new laws to limit disruption from future strikes. Now, for more on all of this, we're joined by our Bloomberg senior reporter for international affairs, Mark Champion, and our Bloomberg senior reporter on UK wealth, John Stepik. So, John and Mark, thank you both for joining us. John, first of all, when you look at the economic impact of the strikes, like, how bad are they?
I mean, in terms of the overall GDP impact, it's actually quite small. That's partly because what happens is whenever a strike happens, economic activity is actually displaced rather than ditched. So, like, if you can't get to work on the train, you spend your money, in your local cafe at home. So that's relatively minor. I mean, obviously, if you're somebody who needs an ambulance on the day the ambulance workers are on the strike, that's a completely separate issue. But in terms of actual economic impact, it's more the strikes are more a symptom of our wider economic problems.
Yes.
So they're happening because inflation is going up rather than the other way around. Obviously, what government and central banks worry about is that then that starts to feed off itself.
Right.
So inflation creates strike action creates higher wages, and so on. At the moment, it's hard to argue we're seeing a wage price spiral, though, I think.
But you could, and this is kind of like a feedback loop. And I guess, politically, for Rishi Sunak, he hasn't been in charge for that long. He's dealing with a number of issues, but this could be very, very dangerous for him.
It's really bad for him. I mean, he was in a difficult position anyway. He's, this is 13 years into Conservative government. They've had a lot of trouble. He replaced a kind of crash and burn effort at an administration. And, here he is, having to deal with really rolling strikes that are becoming wider. And you could argue that he may have misjudged back in early December when it became clear that the NHS in particular was going to go on strike. There's a huge amount of sympathy with the NHS, especially after COVID. People know that these, the nurses and so on are underpaid, they're understaffed, in part because of Brexit, which was also conducted by the government. So, it really is a pretty nasty cocktail.
And Mark, I guess I don't know whether the public is behind at all. These anti-strike legislation could be really damaging, right? So it's basically assuring a minimum service no matter what happens.
Yeah, it's sort of a high-risk strategy, and it follows on from that decision early in December to sort of take a tough line. But you could argue, because the polls suggest that, in particular to do with the NHS, but more widely, the public supports the unions, not the government. So this may be, it may prove to be rather tin-eared.
Yeah, so John, are we going to see an increase in a lot of these salaries? And again, is there a concern that actually inflation, a lot of people, and I think the public is fairly behind a lot of the NHS workers saying nurses absolutely need a bigger salary, but that you increase that salary by 10, 12, 15%, and then inflation comes down?
Well, I suppose what I would say is I don't think it's necessarily about exactly whether the nurses get a pay rise or not. I mean, to my mind, the issue with the strikes is partly political, and it's also being driven by the cost of living going up. If the wider cost of living if the increases in the cost of living start to slow this year, as seems likely, then some of the impetus behind continuing strike action might be taken away. The problem at the moment, I feel, is that the unions have got the bit between their teeth. They can smell the blood of as you say, a kind of like 13-year-old Conservative government. And it's going to take quite a lot of, I think, probably maybe the government backing down a bit in some of these things for it to take any of the heat out of the debate, and we're not seeing that happen at the moment.
But John, overall, is the economy in the UK improving? I mean, we've had such bad figures that I don't know how much lower we could go from here.
Well, I mean, the thing is, it's, when you look at the corporate results since Christmas, the trading updates have all been much, much better than you would have expected if you'd been, just reading the headlines before Christmas. I mean, Next, Tesco, Marks and Spencer, Sainsbury's, Premier Inn, Owner, Whitbread, they've all come out with either solid or actually strong results. So it does appear that the consumer is still spending, and ultimately the UK is a consumer-driven economy. And as long as the consumer doesn't go on strike, then the wider economy itself is probably going to be okay. I mean, we're probably maybe in a technical recession just now, and that's 2 quarters of GDP not growing. But at the same time, I think it might end up being milder than a lot of people expect. And I think that the headlines and also the overall kind of toxic politics that we've had for the past year are sort of creating an impression of the UK that I think probably isn't actually necessarily borne out by the underlying either economic performance or investment performance of companies in general.
Yeah, and actually the earnings are right. I mean, we had M&S and another one, and sales are okay, but they've had to really fight for their margins. So they're trying to keep that shopper loyal because they may switch to cheaper brands.
Oh, absolutely. Right? I mean, you're right. But the thing is, if you were sort of reading the headlines about strike action and the kind of trains going on strike and snowstorms and all the rest of it in December, you would have expected, I think people were thinking, well, somebody's going to come out with a whopper of a profit warning.
Yes.
And as it turns out, we have had profit warnings, but they've been from Direct Line, which is completely different reasons, and also Halfords this morning. But Halfords, again, is kind of specific to that company rather than a result of the wider economy.
And Mark, the number of calls I've gotten from French friends or French journalists and Italians saying, what is going on in the UK? You're becoming so French because of the strikes. Have we really seen anything at this scale in the UK before in terms of people taking to the streets to show how unhappy they are?
Not for a really long time. And people sort of, they look back to the winter of discontent, which was, back in the late 70s. But it was, if anything, I think some of the wrong lessons are being drawn. Some of the same things are happening, high inflation, the government worried about stoking that and therefore, going to bat with the unions. But it was a Labour government. Margaret Thatcher followed. And also, the UK was sort of coming out of, it had just gone to the IMF for money. It was basically bankrupt. As tough as people feel this is, we're not quite in the same position as John was saying.
We also, so the London mayor, is warning today that Brexit has done immense damage to the city. I know, John, you pushed back against this a couple of weeks ago. I mean, is the narrative shifting actually to we need to minimize Brexit, or is this a red herring?
I think it's a red herring. I think it's a very useful stick to beat the government with because obviously, the government has and is heavily identified with Brexit, and obviously the Tory party is massively divided on that front. So it's very useful kind of thing to hit the government with. I do think there's probably also an element of trying to kind of bring Brexit back to the forefront of the political arguments now that COVID is starting to go into the distance again. And obviously Sadiq Khan's a kind of high-profile Remainer, so as Mandy Rice-Davies sort of said, he would say that, wouldn't he? So, I don't think red herring.
All right, there you go. John Stepik on Brexit and, of course, our London mayor. Mark, thank you so much. Mark Champion and John Stepik will be back in a couple of weeks joining us this morning on the UK. Coming up, small and medium enterprises will lead the recovery in the UK economy, but they need more government support to do so. That's Sage EMEA President Derek Bleeker and what he believes. So we speak to him next, and this is Bloomberg.
of push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacroix here in London. Now, just a reminder, we're keeping an eye on all things markets. Yen extending gains to 1%. This is as there's a lot of speculation from BOJ, and of course, the policy that does this comes from traders, gaining to 1% amid some of the speculation. Again, remember, we've had really big news stories from the Bank of Japan over in December, and then we also have Governor Kuroda stepping down in April. There's speculation about who will, of course, come after him, and traders really piling on bets about another hawkish pivot from the Bank of Japan following this report that the central bank will now review the side effects of its policy as soon as next week. We've also had a string of UK retailers reporting this morning, which benefited from a Christmas boost, including Tesco and M&S. The outlook for the year, though, is less optimistic. We'll dig into the numbers now with our Katie Linsell, our UK retail reporter. So, Katie, talk us through some of these retail earnings. What are you seeing?
Yes, good morning, Francine. So the key ones to look at today are Tesco and Marks & Spencer. Both retailers showed that sales rose quite significantly in the Christmas period, but both are saying that they expect their profit outlook to be held. They are not upgrading. They do not expect better than they had previously told the market. And in both cases, they've seen shares fall slightly this morning as investors had hoped for better. So it shows that really their margins are continuing to be squeezed by the cost of living crisis. They're doing everything they can to try and keep prices low, that they say, for consumers. But it really shows that that's eating into their margins. Another interesting retailer to look at is ASOS, the fast fashion online retailer. ASOS has been having a very tough time. Their sales actually fell in the period, and they are guiding that they're going to be loss-making in the first half. But despite that, their shares are actually up because they are telling investors that their turnaround is making progress, and they are hopeful that they can see some signs of profitability ahead.
All right, Katie, thanks so much. Katie Linsell there, our UK retail reporter with the very latest earnings. Now, the UK increasingly facing a perfect storm as the economy grapples with the cost of living crisis, rising industrial action, and political inertia. Now, a report by Sage Group, the FTSE 100 provider of financial and HR services to small and medium-sized businesses, sees SMBs as key drivers for the UK's economic recovery. The report, though, says they need more government support. So for more on this, we're joined by Derek Bleeker. He's EMEA president at Sage. Thank you for joining us. There's so much actually going on in the UK and such bad news out there. Can it only get better from here? What are you seeing among small and medium-sized enterprises?
Well, first of all, thank you for having me. I think obviously, there's no denying the UK is in a difficult place right now. But we do see a lot of optimism and a lot of reasons for optimism. And as the report tries to point out, if we look at the drivers of economic recovery from, for example, the great financial crisis, small and mid-sized businesses are key to doing that.
Yeah, absolutely. And Dirk, one of the things that we've been trying to figure out is actually leverage. And I'm surprised, and I don't know whether this comes in the second half of this year, that not more small companies, medium companies want bust because interest rates have gone up by so much.
I think it's a good question. A lot of that has to do with the adaptability, ultimately, and resilience of small businesses. They can make fast decisions, pivot quickly, innovate quickly, which gets them out of, obviously, then means that they're driving revenue growth, and it gets them out of any financial issues. But financial access is absolutely a key driver to making sure that small businesses can support the economy going forward.
So you don't think there's like, you know, zombie companies that are going to go bust in the second half of the year? There's not a doomsday scenario for smaller companies where, you know, financing and where they were over leveraged?
We don't see a doomsday scenario at the moment. Speaking to our customers, they're trying to work their way through what is a difficult time, but they're doing that by innovating and trying to grow their business.
So where do you see the biggest growth actually for small and medium-sized companies in the UK? I know if you're a retailer, you've been hit quite hard, certainly in the beginning because of Brexit and some of the tariffs going to and fro for Europe. Is this stabilizing?
So if you look at the report again, points to the professional, scientific and technology sector as a key driver, both in the great financial crisis and an expected key driver of economic growth from SMBs going forward.
So where do you see, if you look at the next 12 months, I know we've had such bad news and you're pretty optimistic about the future. Is this just one of trying to, I guess, keep your margins, keep your customers loyal, and then you increase next year? Like, what kind of timeline do you see over the next 2 to 3 years for growth?
Well, look, as a company, Sage itself, we see, we continue to have a good growth momentum, as you saw in our previous year's financial results. And we are a very resilient business, right? We believe in the SMB economy. The SMB economy is proving us right, has proven us right to date over many years. So we continue to see strong resilience.
And are you getting enough support from the government? Are small businesses, medium businesses, and tech businesses in general here in the spotlight of the current government?
I think there's a lot that politicians across both parties are trying to do. But there is a lot more that we can do. And we really, at Sage, we believe in the digitization of the economy. And government has a pivotal role in trying to digitize the economy further. Supporting small businesses to adopt digital technology is a key part of that.
I mean, are you frustrated? It feels like it's been slow. I feel like we've been talking about digitization and more technology for the last 4 to 5 years.
We have. If you look at the pace of digital technology adoption, especially through COVID, it's accelerated immensely. So I wouldn't say that we're frustrated. I think there's just so much more opportunity. We did a report last year that pointed out there's a £230 billion revenue opportunity for small business just from higher digital technology adoption.
Dirk, thank you so much. Dirk Bleeker there, EMEA President at Sage. He stays with us. Now we'll have plenty more, of course, on Bloomberg UK. Coming up, ditching office space. We take a look at how the tech downturn has impacted commercial real estate next. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if we're being honest, this is a plant that cannot hold on much longer in a changing climate.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, Alphabet, Meta, and software giant Salesforce are among the latest U.S. tech firms looking to ditch their leased office space in London. That's as the cooling economy brings the sector's years of rapid expansion to a halt. But it's not a London-only phenomenon. We look at what's behind the retreat.
Following years of rapid expansion, the global tech sector took a monumental hit in 2022. Crashing stock prices, surging interest rates, and an ever-darkening economic outlook forced big tech firms to cut costs. And after slashing jobs at a pace like the early days of the pandemic, FANGs have started offloading office space too. Meta, Alphabet, and software giant Salesforce are among global tech groups ditching offices in London as they downsize European operations. Just over a year ago, these were the very same companies sparing no expense in renovating their shiny buildings in the British capital. Google spent $1 billion on its central St. Giles's complex and built a new campus in King's Cross, equipped with swimming pools, gyms and massage rooms. Facebook followed suit with a new 40,000 square metre space to house over 6,000 UK employees. Last quarter, parent Meta estimated charges related to global office facilities would hit $2 billion this year. So what happened? Certainly the market crash killed some of London's appeal. At one point in November, the UK even lost its crown as Europe's biggest stock market to Paris. But the challenge is global, with offices in tech hubs such as Dublin and even San Francisco being emptied following massive layoffs. Bloomberg has logged some 81,000 job cuts in tech over the past year, with Amazon and Salesforce announcing more than 25,000 last week alone. But it isn't all gloom in London. TikTok was said to be in talks late last year to lease new space close to its current UK headquarters. So is the social media sensation the only company still able to dance its way through the big tech downturn?
TikTok. A lot of us have an account. A lot of us don't use it. Maybe we should look at what's driving big tech's retreat from commercial real estate. So we're back with Dirk Bleeker, EMEA president at Sage. Dirk, when you look at commercial real estate, I mean, is it something that, it's affected, that has the trend affected Sage?
It's not affected Sage, and we're still in our offices and not seeing these kind of trends. We have to take these things into perspective, right? Big tech obviously likes to invest to grow, and occasionally that means they have to pull back a bit. But you know what? It also shows why we have to make sure that we rely on small and mid-sized businesses to drive the next wave of growth to come out of this economy, because they're going to lead it.
Yeah. But if you look at small and medium-sized enterprises, I mean, I guess the biggest challenge is pacing their staff enough, right? And the cost of living crisis, I don't know whether it's staff retention, it's finding the right staff because of the skills shortage, and paying them.
It is, especially skills and finding the right staff we hear that across mid-sized businesses, small business, and big businesses, that's not gone away. And even in these times, it's a structural problem that we need to solve all the way to the ground up from the education system.
So that takes years to fix. Is there? I mean, are you finding? Is it a struggle to find staff?
So we're very lucky in that we have a global headquarter in Newcastle, which is a fantastic place to find amazing talent. and that has kept us going for a lot of years in trying to find fantastic staff. And we invest a lot in making sure we both work with schools in the area to bring STEM skills, take apprentices, and then make sure that we invest in our people in Newcastle and, of course, across the world to make sure they have the right skills to do their jobs.
I mean, there has been this, north-south divide, or London and everything else in the UK divide, and previous governments have really promised to try and, bridge that gap to bring them closer. Has that worked?
I think there's a lot more to do, if I'm honest. If you look across the country, obviously, there is still a big disparity in London and the rest of the country. But we strongly believe that the north-south divide has no real reason to exist. If we look at our presence in the northeast, again, you can find the talent, you can find the people, and it's a fantastic place to be a global company.
All right, Dirk, thank you so much for joining us. Dirk Bleeker, their EMEA president at Sage. Now, be sure also to subscribe to Bloomberg's In the City podcast that I host alongside David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. Actually, this week we focus on banker bonuses and the fact that a lot of them will get a donut. I had to Google what that meant. It's a big fat zero. So it's a focus on bonuses and, of course, some of the staff being laid off at some of the big banks. Bloomberg Surveillance Early Edition is next with Matt Miller, Katie Lyons in New York, and Anne Edwards in London. The big story of the day, apart from these strikes in the UK and focus on GDP in the UK, is, of course, stocks in Europe are gaining ahead of that CPI data print in the US. What does that mean if we have a US inflation print cooling? Does it reduce pressure for aggressive rate hikes from the Fed? This is Bloomberg.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which, as I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
A multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The last time inflation was at the top, or last time inequality was at the top, was more than 10 years ago. We're talking about at the time of the global financial crisis.
I think the Fed recognizes and is embarrassed by the fact that they made a mistake at the end of 2021 and early 22, that they turned out to fall way behind the inflation curve. And I think they're trying to make up for that mistake by possibly making another mistake.
The rates will plateau sometime soon, I think. Maybe not immediately, but sometime soon, and then hang more or less constant for several meetings. And that could well take us through the end of 2023.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The Fed will look closely at today's U.S. inflation reading. It could help determine how much the central bank will raise interest rates next month. German Chancellor Scholz wants the EU to counter increased U.S. subsidies for green technology. He'll call on the bloc to create new joint financing instruments. And Taiwan Semiconductor posts fourth quarter profit that beats estimates, but its capital spending forecasts come up short. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is on assignment. I'm reliably informed, though. She'll be back on the premises, though, in time for the CPI data later on today. Matt, that is what the market is waiting for, essentially.
Yeah, absolutely. I think waiting is the right way to put it as well. In terms of what we see in risk assets, there's not a heck of a lot of movement, even as far removed as Asia. We did see gains, but for example, the Nikkei here unchanged at the close. The Hang Seng up about 1/3%, and the MSCI Asia Pacific gaining the most at 0.7%. A very broad measure of gains there, but not huge. And as you'll see when we look at U.S. futures, we don't have a lot of movement here. S&P futures, really little changed. You can see down 0.03%. And of course, traders typically sit on their hands, even shut off the computers or push the pause button or however those algorithms work ahead of big data releases like the CPI data that is so eagerly awaited today. I mean, my goodness, it could move markets a lot in one direction or the other. I think the average move for a CPI release over the past 6 months is at least 3% in the S&P after the data has been released. So that's a pretty large move for such a broad index. The dollar index is down. So if we have the dollar index holding lower and we get CPI that is better than expected, that is lower than the estimate, we could be off to the races in terms of stocks. On the other hand, if CPI is worse than estimated, the market could go back to pricing in a solid 50 basis points for the increase February 1st. We're going to talk to Michael McKee in just a moment. I can see him here standing offset. He's going to give us a full preview of CPI. Gold, I think very interesting because we climb up to 1884 troy ounce, a 0.5% gain. So gold continues to climb. By the way, speaking of off to the races, if we get a beat on CPI and the Fed is then only expected to raise by 25 basis points, and maybe even after that, just hold. When interest rates come down, obviously, non-interest rate bearing instrument like gold benefits. And then Bitcoin gaining again today, now over 18,000. So after the collapse of FTX, it held steady for 16,000, no volatility, then 3 trading days in a row of over 17,000. Now we're up to 18,000, so maybe we're finally up out of that range. Anna, what do you see in Europe?
Yeah, a lot of investors do seem to have reached their conclusions about the inflation picture in the United States already, almost regardless of the data, Matt, which makes you wonder what kind of market response we could see if we get something unexpected on CPI today. If we get what's expected, though, that will be in keeping with the risk-on scene we've got here for European stocks. So European assets, once again, on the rise. All sectors across Europe actually in positive territory, just underlining the broad-based nature of the rally that we're seeing in anticipation of a dovish print on inflation from the US. And again, underlining the dovish nature of expectations here, one of the most rate-sensitive sectors in Europe is the best performing sector today. So all sectors are higher, but real estate, the property sector, up by 1.6%, the best performing here in Europe in today's session. I put in a retailer just to flag that we are, this week, focused very much on UK retail, grocers as they report numbers. It seems the bifurcation of the consumer in the UK is a big theme because Marks & Spencer's, despite the share price performance, which reflects maybe expectations, M&S has been benefiting from the top end of spending, even as discount retailers have been benefiting as well, as we see customers sort of segregating into different camps. Brent crude is up by 0.9%, 83.40 or so is where we trade back. We heard from Jeff Curry over at Goldman Sachs. He's talking 110 in terms of the oil price on Brent by the third quarter. China and the reopening story is part of the narrative he's citing there. And this is also something to watch when it comes to the CPI data later. 107.61. I've seen a number of people saying, could we go to 110 at some point soon based on a dovish print on US CPI. Just got a note through from Nomura as well, the team there pointing out that a lot has changed in European assets broadly, in particular for the euro in recent weeks, and flagging that the current account in Europe, in the Eurozone in particular, is now verging on surplus.
All right, we'll continue to watch those currencies. Now, investors in the Fed will be looking closely at today's U.S. Consumer Price Index. As we have said, the projected 5.7% increase would be well above the Fed's goal. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now on set for more on what to expect. So there have been a few months in a row of better than expected inflation.
I love the fact that you are so enthusiastic. It's getting everybody pumped up this morning for this. There have been, Matt's right, we could see a better than expected number this morning. When you look at some of the underlying numbers that we've had recently, including the ISMs for both manufacturing and even services, although the services headline number went down, the prices paid number went down significantly, and it is beginning to look like inflation is rolling over. Do we see that reflected in the numbers? I don't know, but the smarter people than me, the economists surveyed by Bloomberg, think so. We will have the first negative print on headline, the Bloomberg survey says, since May of 2020 in the height of the pandemic. The core goes up a little bit, but both of them on a year-over-year basis drop. And that drop is less important to the Fed than those monthly changes because they want to see the sequential movement. And as Matt mentioned, we have had 2 months in a row where they have come in lower than anticipated, and that could certainly have an effect on the markets. The big thing, of course, we're watching, Matt and Anna, is the core services ex-housing. That's sort of a made-up number by Jay Powell because the core services is where we have seen inflationary pressures. A lot of it comes from housing, but the Fed already knows that housing prices, rents are going down. They're just not reflected in the index yet. So Jay Powell said he's following this index, and you know that means everybody on global Wall Street is following this index.
Mike, just to make the point, so we're looking at for moderation as you set out in at least 3 of the 4 measures of inflation that we're going to be glued to on the Bloomberg terminal. So looking for those to moderate. And when we talk about better inflation, we're in a world where better means lower, of course, to try and bring it back down to where the Fed wants it to be. What is at stake in terms of expectations for the Fed then in February and the month after from this data print today?
Well, there's certainly a divergence between what the Fed says it wants to do and what the market thinks the Fed is going to do. There's general consensus they will raise rates at least one more time. The question's been 50 or 25 basis points, and if we get a print as expected today, you're probably going to see a 25. And then the real guessing is going to begin. What do they do when they get to the March meeting? Do they stop altogether, or do they still raise rates again? And then, of course, you'll have me on to talk about whether the Fed is going to be starting to cut rates anytime in 2023. At this point, they're arguing against that.
Dude, we're going to always just keep you on standby. So you just stay right
hanging
here.
in the closet, yeah.
To the right of the set there. Michael McKee there, International Economics and Policy Correspondent. Let's get now over to Maria Tadeo, because Spain and Germany are calling for EU-wide action to boost investments across the bloc in response to President Biden's green subsidies. Policymakers see parts of the Inflation Reduction Act, the IRA, as a threat to European manufacturing. Bloomberg's Maria Tadeo joins us now from Brussels, the EU capital. So, Maria, the issues with the Inflation Reduction Act, with the IRA for Europeans are not going away. What are the key issues?
They're not, Matt, and this is a real zeitgeist in Brussels. Every panel that I go to, every event, every official that I speak to in Brussels, pretty much every day talks about the Inflation Reduction Act. And of course, just to recap for our international audience, this is this massive plan that the Biden administration has put forward to green the American economy. Of course, the Americans say we're doing exactly what we were told for years we should be doing, which is going more sustainable. However, the Europeans say that with huge industrial policy, a lot of subsidies, sometimes a double subsidy, that means that the level playing field for European companies could be severely impacted, and it could be detrimental for Made in Europe. I was very struck on Tuesday when I spoke to the Belgian Prime Minister, and he told me the United States is going behind our backs, and this is the biggest threat for Europe. You cannot have a continent without an industry. Now, you have a number of countries that come up with a number of ideas or have come up with a number of proposals. I would say this is still very early day, but nonetheless, it's the zeitgeist here, how to respond to this, and indicative perhaps that the United States has not come up with the concessions they wanted to see.
A conversation we'll continue to have this hour, Maria. I mean, Germany, you mentioned that a number of countries have come up with ideas of how to solve this. Germany and Spain have put forward ideas around how to counter the US subsidies. Does this mean there is a diplomatic solution in sight?
Yes, and again, I guess going back to the earlier point, the fact that you see all of these ideas that are conveniently leaked, the fact that you have all of this reporting that is emerging, all of these papers that come out and do the rounds in the political circles in Brussels kind of indicates that either they want to exert pressure on the United States to move faster in the direction that they want to see from the European perspective, or actually that they now believe we're not going to get the waivers they were hoping to get in 2023, so therefore we need to move to a counter plan, a plan B. Again, a lot of this is early days. Everyone says officially we do not want a trade war, but there has been this realization that ultimately you cannot be a self-sufficient continent without an industry. By the way, the Americans, just to be fair, they say a lot of the issues that Europe had in 2022 were self-made because of the energy and the foreign policy.
Okay, we'll continue to watch that debate and the solutions being proposed in the absence of a diplomatic solution. Maria Tadeo, thank you very much. Later this hour, we'll be speaking to Ingrid Nestle, a Green member of the German Bundestag, in government, of course, the Green Party, so we'll certainly get the German perspective there. Now, TSMC predicts sales below estimates and says it will reduce spending as the chip industry braces for a potential recession and tighter US trade controls. For more, we're joined by Tim Culpen, Bloomberg opinion columnist in Taipei. Tim, how bad is this year going to be then for TSMC? I guess that's the question.
Well, it's actually not going to be that bad. It's going to be a very bad first quarter. They just gave us the outlook for the first quarter, much below analyst estimates, and the first drop in 4 years. But the CEO joined the conference call today and told investors, look, it's going to be a V-shaped recovery, not a U-shaped recovery. So it'll bounce, it'll hit a bottom in Q1, Q2. Second half will be very, very strong. And so on a net basis for the whole year, they will see some growth. Now, that's unusual because the chip industry is very cyclical, and usually when we have a downturn, we do actually have a fall in revenue. So the fact that they can come out of it basically even, a little bit up during a downturn, is a very good sign for TSMC.
All right, Tim, thanks very much. Bloomberg Opinions, Tim Culpen joining us out of Taipei to talk about this big TSMC story. Now, in other tech news, Bloomberg has learned that T-Mobile may buy the budget wireless carrier backed by actor Ryan Reynolds. That is Mint Mobile, of course. The second largest U.S. mobile service provider has been in talks with Mint, but no final decision has been made. Alex Webb of Bloomberg Quick Take joins us now for the details. Alex?
Yeah, Bloomberg is reporting that T-Mobile is in talks to acquire Mint. Let's remember this company was founded about 6 years ago, spun out from another small mobile operator called Ultra. It runs on T-Mobile's network already, and Ryan Reynolds is really brought in sort of as the hype man, and he does all the marketing for the company. And he has, though, bought a 25% stake in Mint. So if this works out, it could be something of a payday for him. He has a pretty good track record as an entrepreneur, don't forget. His gin company, Aviation Gin, was acquired by Diageo for something in the order of $600 million a few years ago. So he will clearly be hoping for a payday of a similar order. It is considerably smaller than T-Mobile, don't forget. T-Mobile has something like $80 billion in annual revenue. Be surprised if Mint has even 1% of that. But it is an interesting acquisition, given that T-Mobile has already done significant acquisitions in the form of Sprint.
Yeah, interesting to see there is still a need for scale there, more scale. Thanks very much to Bloomberg Quick Takes. Alex Webb with the latest on the mobile space over in the US. Coming up on the program, Matthew Savory joins us, BCA Research Chief Strategist. We'll talk about the CPI print, what's at stake when it comes to market response. We'll also get back to that European response to US policy on inflation. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center. Wall Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in focus today on Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. Now, for those of you listening, you won't get to see the technicals chart that I'm about to pull up, but I mean, technicals are just so questionable anyway. Nonetheless, I will show our television viewers that we are reaching a pivotal point in terms of this equity rally. We've drawn a trend line on the tops on the way down here since the high, and it looks like we're about to pierce that trend line. Certainly if we get CPI number that's better than expected, we could see that happen. Joining us now is Sagarika Jaisankani, Bloomberg equities reporter, to talk about the optimism that has come up recently. Yesterday, Sagarika Yardeni on Bloomberg Surveillance said, we're in a bull market now, and a lot more market watchers have become increasingly optimistic.
That's right. Today, as you said, is all about that inflation data, and the mood in the run-up to the data, as you said, has been generally optimistic, with consensus saying that the peak in prices has passed. The S&P 500 has rallied in 3 out of the past 4 sessions, which is a signal that the market is positioned for another softer print today. I will say the gains in U.S. futures have paused a bit this morning, as investors are holding off on making any big bets ahead of that data, while Europe is a little bit higher, catching up to that rally on Wall Street yesterday. But choppiness could pervade before the data.
Yeah, absolutely. Choppiness, volatility even. I mean, we've seen, Sagarika, volatility in bond markets and FX and commodities, and a lot less volatility in stock markets, really, in recent weeks. Some of our colleagues at MLive looking at the VVIX, so the volatility in the VIX itself, and saying that's at the lowest since 2014. You do have to wonder how that sets us up for the print later on.
Absolutely, and actually the print today could be very pivotal for markets, because as you said, as I mentioned earlier, that the market is positioned for a softer print. So if we do get that, then that has potential for the S&P 500 to extend the rally in the next few days. However, any disappointment, conversely, could not likely be taken well, and we could even have a reversal of the gains that we've seen so far. And I do want to mention at this point that, of course, we're seeing decidedly hawkish signals from Federal Reserve officials. So strategists have warned that that disconnect between what the market is expecting in terms of policy and inflation and what the Fed is signaling could also see that volatility go up over the next few days.
And we're going to hear from so many Fed officials, aren't we, in the sort of 24 hours after the data hits. That'll be something else to sort of complicate the market's response to the data. Thanks so much, Sagarika. Bloomberg Sagarika Jaisankani joining us here on set in London. And for more market analysis, check out the Market Live blog. The Market Live team, then, you can find them at MLive Go on your Bloomberg terminal. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden's efforts to quell a controversy over classified documents in his private possession has become more difficult. Aides have found a second set of papers that's likely to fuel criticism from Republicans, even though they dismiss more serious allegations against former President Donald Trump. And China hasn't updated its daily COVID reports for 3 days. That's adding to global concerns that Beijing is masking the true impact of the world's largest outbreak, no pun intended. The World Health Organization has renewed its call for more COVID data from China. In the UK, more pressure being piled on Prime Minister Rishi Sunak's government. Some 100,000 civil servants announced plans to extend a strike next month. That news came after healthcare and rail unions signaled they're far from resolving their pay disputes with employers and the government. And Bloomberg has learned that a corrupted file led to the breakdown of an air safety system that prompted flights across the U.S. to be grounded. Both the system that provides critical information to pilots and its backup failed. Almost 10,000 flights were delayed. And finally, UK shoppers spent more on vinyl records than CDs for the first time since 1987, according to the Digital Entertainment and Retail Association. Total music sales, including digital and physical formats, grew 3% in 2022 to almost $2.4 billion, their highest level since 2003. So I guess a lot more people listening to music and a lot more people spinning discs, not the compact kind.
Absolutely, and I hear you have a vinyl collection. We'll have to find you something to play them on, Matt. I guess I was not surprised that, anecdotally, you hear a lot about vinyl sales on the rise. I was probably quite surprised how few people are buying CDs, obviously streaming very much to the fore. Coming up on this program, we will go back to the markets. We'll talk markets with Matthew Savary, BCA Research Chief Strategist. What does he make of the strength of European assets since the start of the year? Is that at stake on this CPI print from the US later? This is Bloomberg.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed will look closely at today's U.S. inflation reading. It could help determine how much the central bank will raise interest rates next month. German Chancellor Olaf Scholz wants the EU to counter increased U.S. subsidies for green technology. He'll call on the bloc to create new joint financing instruments. And Taiwan Semiconductor posts fourth quarter profit that beats estimates, but its capital spending forecast comes up short. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment today, and really it's all about the US inflation print. As we were hearing from our colleagues earlier on in the program then, Matt, we'll get a market perspective on what's at stake really with this print today in a moment. But really the focus in terms of the data will be on to what extent we're seeing a moderation in some of those key readings, including core services.
Yeah, we cannot stress enough how important today's CPI release is at 8:30. The result will drive risk assets in one direction or the other, and typically we've seen fairly substantial moves. Over the last, I think, 6 or 7 CPI reports, we've seen the S&P 500 move 3% in one direction or the other, which is a massive move for such a broad index. Now, S&P futures currently are unchanged as, it's risky to place your bets ahead of time unless you've seen the numbers, which would be illegal, of course. Bloomberg Dollar Index down a little bit, so that's going to amplify a move up if we get a better than expected number that is lower than expected on CPI, meaning the Fed won't be forced to raise as much as it would have been otherwise. Gold also gaining right now, $18.83 a troy ounce. I just think it's pretty interesting to watch this asset rise, as it, of course, has no interest, no yield, no coupon here. So as the expectation for the terminal rate falls, the value of gold rises. And of course, as a pivot approaches, the closer a pivot gets, the more you should see gold, theoretically at least, rise as well. And then Bitcoin, right now worth more than $18,000. Pretty stunning by itself, that fact, but also since we've seen it move higher after the collapse of Sam Bankman-Fried's FTX empire, it just really is fascinating. So more than $18,000 for one Bitcoin. Let's get to some of the pre-market stock movers this morning. Netflix is one of them, up after Jefferies analyst Andrea Urquhart raised the recommendation to a buy on the stock. It had been a hold previously, but the analyst citing upside surprises to the 2024 operating margin, or at least a forecast for that. And as a result, you can see it's up more than 1.33% in the pre-market. Coinbase also rising. The crypto exchange, as the price of Bitcoin rises, you'd assume as trading activity rises, that's good for Coinbase. And as a result, it's up this morning more than 2% in the pre-market. Roku, on the other hand, is down. An analyst, the same analyst at Jefferies, talking about Netflix, cut recommendation, Andrew Urquhart cut the recommendation on Roku shares to an underperform, or what could be translated as a sell from a hold. The price target there set to $30, and it implies a 40% decrease from the closing price yesterday. So coming down 3% in the pre-market. Autoliv also off more than 3% in the pre-market after an analyst at Nordea cut its recommendation on Autoliv, the GDRs, to a hold from a buy. Price target there at 990 kroner implies a 22% decrease from the kroner closing price, and you can see in dollars we're down 3.33%. Anna, what do you see in Europe?
Let's have a look at the European picture then. So European stocks up by 0.5% this morning as we look ahead to the print out of the United States later. The property sector doing pretty well. It's a broad-based rally we're seeing across European stocks, and actually to underline how perhaps complacent markets are ahead of that CPI print in the US, we have the very rate-sensitive property sector is one of the best performers in this morning's session here. Brent crude up by 1.2% today, 83.69. We had Jeff Curry over at Goldman Sachs telling the team just yesterday that we could get to 110 on Brent in the third quarter of 2023. So they are expecting at Goldman's then the reopening in China to have something of an impact on oil markets. And euro dollar, to Matt's point earlier about things being pretty unchanged ahead of that CPI print, we're entirely unchanged on euro dollar. 107 is the handle. Closely watching European assets, and I got a note from Nomura a little while ago talking about how so many things have changed in the European asset space, whether that's European stocks or in their case the euro over the last few weeks. They're increasingly watching what's going on with the current account, which is edging back towards the surplus that we know and love, of course, in the Eurozone. That is situation normal. Now, in talking of the European story, I just want to bring you a headline that's crossed the Bloomberg in the last few minutes. The UK and the EU are aiming for a final deal to end the Brexit clash, I'm reading from our colleagues who are covering this story, in fresh talks. Whether this is specifically around the Northern Ireland Protocol, that has been an area where we've seen sticking points, but indeed talks have been taking place on that. So maybe this is something broader. We'll look for further detail, Matt.
All right, we'll definitely continue to pay attention to that. Joining us now is Mathieu Savary, BCA Research Chief Strategist. Mathieu, today I guess is all about inflation, but not just today, right? Your call for the Fed, your call for markets, really for the economy depends on a lot on this number. What are you expecting?
Yes, thank you very much for having me. So today we do expect some moderation to continue to take place in the US CPI report. However, the stakes are very high right now. Clearly, the way markets have been trading suggests that investors are already anticipating a very positive number, so lower inflation reading. So I would suspect that the risks are skewed, that the inflation number disappoints a little bit considering the trading we've seen in recent days. But generally speaking, the trend is still for inflation in the United States to decelerate, which will allow the Fed to continue to curtail the pace at which it's increasing interest rates over the coming meetings.
And Matthew, good morning. I know you spent a lot of time developing the European investment strategy. With that in mind, what are you watching for in the inflation print out of the US today? Because that could have a big bearing on the euro, and the European asset story has been getting a lot of attention so far this year.
Yeah, well, the European assets are extremely cyclical, so they've benefited a lot from decreasing inflation fears because of that cyclicality. I mean, there are other things that have helped Europe a lot in recent weeks, and namely, we're talking about the decline in energy costs in Europe, as well as the hopes associated with the reopening of the Chinese economy. So Europe is about more than just the Fed. But if we don't see a sign that the decline in inflation in the United States is broadening, European assets, which are getting a little bit ahead of themselves, let's be clear here, are likely to experience a bit of a pullback in this context.
So a little bit of a pullback, you think, maybe getting ahead of themselves. And so with that in mind, Matthew, I know that you like European defensives. So is that healthcare? Is that utilities? I've spoken to a couple of guests this week who've been talking about the European healthcare sector. So where do you see opportunity?
Yeah, I think the healthcare system is still, healthcare stocks, are still pretty attractive in the euro area. At the end of the day, a lot right now rests on the impact of the reopening Chinese economy on Europe. And BCA's emerging market strategists think that, yes, the Chinese reopening is extremely important, especially for the domestic economy in China. But when it comes to the industrial sector, BCA is very worried that at the end of the day, we're seeing a decrease in the pace of issuance of local government bonds that has happened in the past, which is associated with a decline in infrastructure spending. And yes, real estate could improve, but net-net, we don't see an enormous improvement in investment in China over the course of 2023. And that is, at the end of the day, something that is likely to weigh a little bit on European assets, especially considering how fast they've rebounded. So that's why I think remaining a little bit defensive, invested but defensive, makes sense at this point in time. When it comes to the healthcare sector in particular, we like it because it is very advantageous from a valuation perspective compared to a lot of the other defensives in the euro area. We are seeing also in terms of rotational patterns, it's behaving pretty well right now. And if yields can continue to decline a little bit in the United States and decline further in Europe, that would be also very beneficial for the healthcare industry.
Do you like, I mean, speaking of yields, fixed income has some pretty juicy yields right now. You do seem a little bit more pessimistic than consensus in terms of your outlook for the economy and for risk assets. What do you think about, you know, the yield to worst you can get on IG, for example?
Well, we do like IG in Europe quite a bit at this point in time. We think the valuation, when you look at the break-even yield, so the spreads essentially adjusted for their duration, is very attractive. It is one of the assets that is most discounting a significant slowdown in Europe right now. So that makes them attractive. In the US, the picture is a little bit more complicated due to the fact that the valuations are not nearly as attractive as in the Eurozone. And then we have two scenarios ahead of us. Either we get a more significant slowdown in the United States, which means that the Fed can ratify the pretty optimistic expectation that there will be rate cuts in the end of the year. And that would be positive for the spreads, but then a weak economy is very negative for the cash flow and the default. Then if the economy is stronger than we expect, we end up in a situation where the Fed is unlikely to ratify those interest rate cuts that are priced in the curve in the second half of 2023. And that's also negative for spreads. So in this context, I would say that the spreads in the United States are not well priced enough to dip into them, while those in Europe are attractive enough in the investment grade space.
Okay, Mathieu, thank you very much for your time. Mathieu Savary of BCA Research, thanks for joining us. We look ahead to that US inflation data, the big data points of the week. Now, coming up, we'll talk politics and the global economy. German Chancellor Olaf Scholz calling for EU funding to counter US subsidies for green technology. Up next, we'll be speaking with Ingrid Nessle, Green member of the Bundestag. We'll get the German perspective then on the Inflation Reduction Act in the US. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think long
profit today, it's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, German Chancellor Olaf Scholz is calling on the EU to create new joint financing instruments to help compete in the transition to cleaner technologies. Bloomberg TV's Oliver Crook joins us now from Berlin with a key German lawmaker. Oliver?
Thanks, Matt. We're here with Ingrid Nelson from the Green Party in the Bundestag. Thank you so much for joining us. There is a lot to talk about. There is the Inflation Reduction Act and a lot of other things. I'd like to put that aside for just a moment first and begin with the situation here in Germany. It seems that the weather has prevailed for Germany and that we are potentially out of the woods for this energy crisis. What does Germany need to do before the next winter in order to increase its security in energy? What is the one thing that you'd say is the most important thing to do before next winter?
Yeah, indeed, the winter and the weather has been nice with us, so we're in a much better situation than many people have feared during the summer, and the gas storage is really, really high. Actually, the next winter might be even more difficult gas-wise, because last summer we still bought gas from Russia, and they are not selling us any gas anymore. So this summer we do not have this source to refill the storage. I think we will be in a better situation electricity-wise, because it was a really dry year the last year, because the nuclear power in France half of them didn't work at all, and so there was a real shortage of electricity there. Actually, I think that the crisis mechanisms that we have installed during the past year, and that were at least 10 laws and a lot of things that the government has done, that they will still work this year. So this year, the focus is more on getting the energy transition even faster, even to integrate the renewables better, and not to have a lot more crisis
And on the question of the transition, coal is a big question. It's a big question today. There's a village in Lützerath that is being demolished, or it's being cleared now of protesters that are protesting this coal mine being expanded. What is the role of coal, and why is it preferable to, say, nuclear?
Well, actually, nuclear is almost nothing anymore in Germany. We have 5% or 1% of the German energy consumption is nuclear, and we've decided to move out of this and to buy new nuclear fuels, which set us for years again into this old technology that we've decided not to go into because it's so expensive, because it's not safe. And the amount is so small that really the entire discussion is incredibly big compared to what it really does on the ground.
And on the question of coal, do you think that the government's position on lignite and these sorts of projects undermines Germany's climate goals? And is it, do you think, strictly speaking, necessary for energy security to proceed with these kinds of projects?
Well, I think it was very wise to use more lignite during this winter and the next winter, to have this really abrupt shortage of gas, to deal with this really abrupt shortage of gas because of no longer getting any from Russia. And we had more than 50% of our gas from Russia. So in the short run, we need something to move in to keep our system stable. And this is what lignite is. But this doesn't mean that we are getting worse on the climate targets. Actually, I think that this is a real booster for renewables and efficiency as well. And they are not here for the first winter or for the second winter. But I think that we will now have a lot more renewables in 2028 than maybe we would without this crisis. So we are really moving into a good position there.
It struck me, Ingrid, last night as I was reading the story on the EU preparing potentially for shared debt to increase speed up the transition to green, really the IRA has been a fantastic thing, right? If we start to get into a subsidies war where different regions are trying to boost green energy with more and more investment, that can only be good for the global fight against climate change, right?
Oh, well, definitely it is great if we get into a race who is going to be the fastest on renewables, on energy efficiency, on the transition. Yes, I love that. I'm not sure that a race for subsidy is the same thing. I mean, we want a good economy. We want the entire economy to transform to a climate competitive economy. And in the end, you can't do this solely with subsidies. Yeah, so I don't think it is wise if we now run into a race for subsidies. But yes, I absolutely do think it is very, very wise to now go into the competition for how can we manage this transformation good and fast.
Okay, that's interesting, Ingrid, because I wonder whether the European position on this should be that we don't want to see subsidies in the US or anywhere, or should the European position be, okay, if you're going to subsidize, then we want to subsidize as well? I know that Spain and Ursula von der Leyen herself have been suggesting easing of state aid rules to accelerate investment. Would you support an easing of state aid rules to drive investment into green?
Definitely, there will be subsidies in Europe as well, and there will be substantial subsidies. I was more trying to say they might not be the exact. The Inflation Reduction Act is a really huge subsidy. It's not just a subsidy. It's very potential, and I don't think we will just answer in the same way and say, okay, now the same quantity of subsidy over here, and then you might say, oh well, then we put an extra 10% because we want to have a better subsidy, and then we will put another 20%, and I don't think this would be wise. But definitely subsidies are a part of the answer, and there will be subsidies, and of course we need to support the economy in the transformation, otherwise we might just get stuck in the old world. And I think we will even have a broader view of subsidies, meaning that we will not only we want the company that produces the renewables, but all the companies that produce whatever, pencils and houses, that we will help them to transform, to use the renewable electricity. And of course, the state money.
Ingrid, I have to just jump in here and make sure I'm hearing you correctly. You think it would be a bad idea for the U.S. and Europe to compete to see who can have the highest amount of subsidies for green energy. I just can't believe that a green lawmaker would say that.
Well, sure. I mean, subsidies are not the only answer to get a good economy. I want this entire economy to run green. Yeah, and this means that I want a competitive economy, that I want them to find the best solution. And this is not the highest subsidy that will find the best solution. You do find subsidies to support the good ideas, but it can't be the only answer.
All right. Excellent. Great having you in the studio. Thanks so much for joining us. Ingrid Nestle there in Berlin with Oliver Crook to talk about, the situation that Germany is in, the situation Europe is in, and globally, our fight against climate change. Coming up later today, we're going to discuss the U.S. inflation report with Council of Economic Advisors member Heather Boushey. That's at 2 p.m. New York time, 7 p.m. in London. This is Bloomberg.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now at 8:30 a.m. New York time, we'll get that key U.S. inflation report. Valerie Teitel, Bloomberg Markets reporter, joins us now with a preview. Valerie?
Hey, Matt, good morning to you. Look, today's print is going to be big. I'm going to be focused very, very squarely on the core CPI month-on-month number. The consensus is for a 0.3, but there's a lot of big houses out there calling for a 0.2. I'm even going to want to know the second decimal on this number. If it is a low 0.2, I think that could really ignite the equity market into thinking that the Fed's next hike could be their last. But if it comes in hot, Matt, I want to know, is it coming in the core services X housing component? This is a component that Powell has dragged our attention to over and over again. Mary Daly cited it on Monday in her interview as well. If it comes hot in this component, that could be driving us to worry that possibly this tight labor market, these wage gains of running over 5% year on year, could be driving inflation into delivering these core services. That would be the early signs of a possible wage price spiral. Now, we haven't seen that recently. This component has been softening the last two prints, and that is without any weakening in the unemployment data in any of the U.S. labor market, leading us to believe that this immaculate disinflation narrative could come to fruition, that we could really see core inflation continue back to trend without unemployment ticking much higher. But look, if this print comes in hot today and it's due to this core services X housing component, I highly doubt the equity market is going to like that very much, and we could price in 50 for Feb.
Right, really interesting. Yes, running into this number, Valerie, we certainly had some dovish expectations as evidenced by some quite bullish positioning on risk assets. Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest. And she'll be looking for 2 decimal places on month-on-month inflation. And if she does, then so will I. Right, early edition is done with for today. Straight after this, Bloomberg Surveillance. This is Bloomberg.
DHL is sending a consistent message with its investments.
The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
To a certain extent, these forecasts about recession are a bit outdated.
The outlook for the world economy, I think, is actually improving.
Keep in mind, all the central banks in the developed world are still hiking rates.
The overhanging main event of the year is going to be what amount of damage have global central banks done to the economy.
I think perhaps for the end of 2023, risks actually are to the downside to the consensus.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is CPI Thursday, live from New York City this morning. Good morning for our audience worldwide on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Bramo's going to be back in a couple of days. Equity futures this morning, basically unchanged on the S&P 500. TK, you know it, next stop, 8:30 Eastern Time.
Really important, not normal. Let's ask why. Michael McKee will join us. We've got a great set of guests to inform you of the ramifications on this in economics, finance, and investment. And the answer is, John, it's a great partition. It is goods dynamics and services dynamics. The adults like McKee are going to look at the service changes.
The Boston Fed president leaning into a 25 basis point hike in early February. Is that the direction of travel now, do you think, over at the Federal Reserve?
Yes, I think that's the parlor game, and we're not going to stop the show on this right now, but it's a global CPI Thursday, and it's the same debate in China, in Japan this morning, and to bring it back to the United States. Post-pandemic, is inflation the metric, the price, if you will, of all of those medical ramifications? Goods, almost outright deflation in the United States.
Goods disinflation. So will we get goods inflation off the back of China reopening? You mentioned Japan. Will we get a change of policy in Japan? A little bit earlier this morning, there was a local newspaper report, suggesting there may well be a policy review as soon as next week.
I went right to the Japanese data, which I'm not expert on, always making for good morning television. And you look at Tokyo core inflation, John, off the Bloomberg, and it was 2.5%, and all of a sudden it's 2.7%. So their institutions are pushing against rising inflation still. Citigroup out, we'll talk about this later again, they say they will abolish yield curve control.
Have you seen where JGB yields are this morning?
Haven't seen that.
That far away from that upper band.
Yeah, they're
50
right up,
basis
they're
points
squeezed right in the
they're
bound.
right up against that ceiling.
It's not that it's been a failure, but they're doing it in steps, and so much of this is maybe an Asian method, much like what we would see in China or, frankly, Thailand.
It's becoming deeply unpopular. I think that's the change over in Japan. There was a survey from the BOJ. It was the BOJ's own survey. More than half of Japanese households said their livelihoods have worsened.
Yeah. I take real issue with how it's covered in the West, and to me it's just rising inflation, and their 3% inflation within the spirit of their economy, off the top of my head, is equivalent to 5 or even 6% inflation here.
Dollar yen 131. very close to 130, 129 all over again. The lower the session, 130.86. We'll pick up on that in just a moment. Let's whip through the price action just briefly and get you set up for the inflation report coming in about 2 hours and 28 minutes time. Equity futures looks like this.
Do we have a countdown clock?
Equity futures unchanged on the S&P. I think we probably have somewhere, Tom.
Yeah, we have to have
We'll try and get that up for you.
Super core clock.
In the bond market, yields lower by a basis point on a 10-year, 352.80. I was looking at where the 2-year was at the close yesterday, Tom. The 2-year yesterday.
Well, there it is. 70 basis points. We're back to negative 7.0 basis points. That's 0.70 percentage points difference between the two yields, and that's significant.
The 2-year at the moment, 422. Do you know where we were at the close of the last inflation report, December 13th?
No, please.
422.
Okay.
Hardly done anything in the last month.
We've
From
had,
point to point,
we've had
anyway.
4 days of equity joy. The VIX 21.75, Dow 34,000. Are we going to get 4,000 SPX?
If we get a big downside surprise,
Yeah.
I think that's on the table, sure. But that's if we get a big downside
surprise. Or are we going to recapitulate the next 30 days, have this equity wonderment, and then, oh no, they're going to raise rates.
The Fed's going to raise rates and keep on going. George
Where's
McCalmo's
Bramo?
joined
We
us
missed
now.
Bramo. That's what she would say.
Head of US macro strategy at MUFG. George, let's go there. 8:31 Eastern. What do you think that conversation is going to look like?
Look, I think that there's a lot of hype for this number. I mean, it's the beginning of the year. It's the last inflation print before the Fed meeting. And, markets are so super focused on inflation. Look, bond markets have been doing that forever. Equity folks have kind of learned how to operate within a CPI Thursday, Friday, whatever day it is. but literally, I mean, there's so much hype that I'm actually concerned that we've kind of over-tweaked it before heading into the number. And there's going to be disappointment. And it might actually either come flat or even a little bit higher than expectations. And that would really mess up the markets here.
Are we disaggregating in our inflation analysis too much? Are we separating itty-bitty parts of the entire inflation picture too much?
Not only are we doing that, Tom, but we're also extrapolating. I mean, I think it's a prevailing view now, and I think it's right that we're heading lower in inflation, and we've seen a peak, and that's all fine and good. But this is the more difficult time between now and March, where we have like the base effects, which will really kick in higher at that point and really drive inflation lower. But at this point, it's a lot more noisy. We have all these various sub indices that are giving us different degrees of disinflation versus inflation. I think this one's going to be a harder one to call.
George, you're expert on this. You've been doing it for years. Whatever the estimate is, let's say 6.5%. Olivier Blanchard out with his perfect book, and he says we're not going to get back to 2%. Essentially, that's the length of his work. What level would make you comfortable? What level of inflation provides Goncalves comfort?
I think as we get closer to 3% on an annual number, but quite frankly, a string of average inflations of around 0.2, which has been the historical average month after month after month. If we see stability, because inflation vol has also been the problem too. It's been all over the place. So not only has it been high, but it's also been random. So if it kind of stabilizes here and we get to a more steady state, somewhere around the 3s. But then you have Chair Powell's favorite new measure, the core services ex shelter. That historically has been around 2 post GFC, but before GFC it was around 3.5. So are they going to be happy if we get to 3.5%? It's currently running at 6.8 or higher. So I think that's a big deal here. That's metric that Powell has emphasized. He's really living to that. So if that thing doesn't come down until the end of the year, the Fed can stay on hold or even hike even further.
George, the payrolls report feels like a month ago, feels like an age ago. It was Friday, and we were talking about the immaculate disinflation. Can we get wage growth to come in? Can we get that disinflation without unemployment going higher? Do you think we can?
I think it's tricky. I mean, the long lag, variable lags of Fed policy, it's still working its way through the system. We just don't know. And I think that, we've had decelerated in the jobs picture. We've had mixed signals within the jobs market, still relatively healthy, and there's obviously tightness in the market, but I think the Fed wants some slack back in. They are projecting a higher unemployment rate, and it's going in the opposite direction. They're going to have to fight for it.
Complicated by the growth backdrop as well. Neil Dutter of Renaissance Macro published yesterday. I want to share this with you, George. He thinks the consensus is offsides. He said this: financial conditions are now easing and have been for a couple of months, supporting economic growth right now. Instead of long and variable, I think the lags are short and predictable. George, what do you make of that short-term call, at least for the next quarter or so?
Look, a lot of this comes down to not just the liquidity dynamics and the tightness of Fed policy relative to market conditions here in the U.S. A lot of it is global as well. and what's going on with ECB QE, what's going on with QT, and also the Bank of Japan changing their policy. So I'm not so sanguine on that. We've already had a big rally in the 10-year. We've gone from 4.25 down to 350. How much further can you really get in terms of financial conditions easing? So I think a lot of it's already priced in.
George, how does this analysis fold into what our viewers and listeners really care about, which is the housing market? I mean, mortgage rates have come down. I get it, but they got to come down a lot to resurrect the American housing market, right?
100%. I mean, there's a stalemate in the U.S. housing market right now. I mean, there's buyers and sellers that are not looking at each other with a clear eye, and no one's really flinching. I mean, at some point, either supply is going to have to start moving and prices are going to have to start dropping, or rates have to completely come off. But we're not going to get that given the environment that we have of high inflation still and the Fed.
You know, to Irving Fisher, not Stanley Fisher, but of another time ago, is inflation linked to interest rates? There's some point where you get such a disinflationary plunge, they actually decouple.
We've had moments of that before too, but the thing is, I mean, you still have a core base rate of a Fed that's looking to go to 5% or higher. And it's going to be hard to see the 10-year completely diverge from that. And if that's the point, there's all these inconsistencies around market narratives that somehow we're going to have a soft landing, but the stock market is pricing a recession.
Just want to finish on the BOJ, if we can, George. You are of MUFG, so this feels apt. There's a local news report doing the rounds today about potentially a policy review at the Bank of Japan. There's now speculation that they drop yield curve control completely. Where are you on that, George? What's your base case?
Yeah, so we do think that with the changing of leadership at the BOJ, as well as what's been going on with the inflation backdrop, and the need to really kind of open up the actual trading markets and the private markets within Japan back, not just being sponsored by the BOJ, we do think that the yield curve control will most likely be abandoned at some point soon in Q2. But look, it's been a year of record moves in 2022. Now we have these big changes coming out of Japan. I think that they're very methodical. They're going to take their time to kind of ease our way out. I mean, I heard Tom at the Open. I think he's right that it's not going to be like one full swoop, but it's still going to have profound effects on both Japanese markets, but notably the U.S. bond market, which has been a recipient of flows for so many years.
It's been an anchor of the global bond market for decades now. We've released a couple of those anchors over the last 10 years, including the bond market. George, thank you, as always. George Concaba's there of MUFG. If you look at the FX screen today through G10, you'll just see Japanese yen strength, just absolute standout in the crowd. Dollar yen 130.97 right now, Tom. That's a move of more than 1% this morning.
Yeah, there's a lot to say here. I'm going to go to the ECO screen of Bloomberg on Japan, John, and just one of the tea leaves out there. Inflation-adjusted cash earnings. Remember, with Japan for 30 years, we've talked about disinflation-adjusted or outright deflation-adjusted. Forget about that. There's real inflation there, and real cash earnings were supposed to be negative 2.8%, and they came in negative 3.8%. That's the surveys you see that you mentioned, John, in Japan. This bank is not dealing with Chairman Powell. They're dealing with the people of Japan, which is let's go. Citigroup, unlike what you heard from MUFJ, Citigroup would suggest we're going to see it with Kuroda and not with the follow-on.
Interesting. So this happens before we get to
April.
Yeah,
we'll do it later. We got too much to talk about, but, I mean, it's inflation. Oh, good. We got the countdown clock up, the U.S. CPI report. Can we have a clock that says supercore inflation?
2 hours and 18 minutes away. Is Mike McKee going to come on and talk about supercore inflation?
Yes, actually, seriously, it matters.
We should have that chat. Yeah. Coming up as well to weigh in, Seema Shah, Chief Global Strategist at Principal Asset Management. We'll have that conversation in the next hour. Pushing ahead to CPI in America. What does Sarah House of Wells Fargo call it? The final mile?
The final mile.
Was the harder mile. Yeah. As we get down to 5, it's the push to 3, 2.
Are the airplanes flying this morning? I think so.
I hear they are. Yeah. I hear they are. Some real disruption yesterday.
Yes.
Catch up with Anne-Marie next about that.
Really effective.
She avoided that disruption.
Brammo got nailed.
Brammo got nailed? You heard from her? What did Lisa say?
I got a text as she took off. The Gulfstream had to sit there, and they're on the runway.
Futures unchanged on the S&P. Your inflation report. 2 hours, 17 minutes and 53 seconds away.
Keep
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, have you been hearing? Investors in the Federal Reserve will be looking closely at today's U.S. Consumer Price Index. The projected 5.7% increase would be well above the Fed's goal. Now, that would explain its intention of keeping interest rates higher for longer. But the year-over-year price growth would also show moderation. CPI is due at 8:30 New York time. The UK and the European Union are preparing to enter an intense phase of negotiations to end their dispute over Brexit. The talks are set to begin next week. The disagreement has to do with trade. Both sides originally agreed to allow Northern Ireland to remain in the bloc's custom arrangements, but so far the UK has failed to implement parts of that accord. President Biden's efforts to quell a controversy over classified documents in his private possession has become more difficult. Aides have found a second set of papers, and that's likely to fuel criticism from Republicans, even though they dismiss more serious accusations against former President Trump. And Subway is exploring a potential sale that would value the sandwich chain at more than $10 billion. Sources tell Bloomberg the process is still in the early stages and the privately held company could decide against it. Subway is one of the world's largest quick-service restaurant chains with about 37,000 locations, but its rapid growth has been tapering off. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday only on Bloomberg. Prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in focus today on Bloomberg.
Because we're coming up on the FAA reauthorization where we'll be approaching Congress, indicating the resources and strategy that we think we need for the next 5 years to make sure that FAA has everything that they need. What people need to know is that we will not allow anything to take place that is not safe.
Spare a thought for Pete Buttigieg, the US Secretary of Transportation, who didn't get to celebrate Christmas, Tom, because the events of Southwest starts the new year, and all of a sudden we have that issue with the FAA.
Forget about the politics of this, and I get it, he's a presidential candidate, so obviously the other side's going to go after him.
Unofficially, Tom.
There's no head of the FAA. The reason he's so visible is, can you imagine Anne-Marie Horton as the head of the FAA?
You think that would work?
She'd come out. She would have been there on the tarmac at National.
You're trying to get MH a new job?
She would have been there at 8:45 going, we're going to get this fixed. Buttigieg's got nobody.
You didn't hear much of that yesterday, did you? From New York this morning, good morning. We're hoping for a day ahead full of airline-free chaos, I guess, Tom. No disruption whatsoever after the mess from yesterday. Equity futures right now on the S&P, totally unchanged on the S&P 500. Equity futures going absolutely nowhere after putting together 2 days of gains on the S&P. Can that continue? Yields are lower by a basis point or two on a 10-year, 352.25, euro dollar 107.63. Basically unchanged there too. WTI crude, 78.35, so positive 1% there. Jeff Curry of Goldman on with Guy Johnson yesterday. Best reopening play. Straight up, he just said it's crude. Then he came out with a monster number for copper. Take a listen to this. End of 23, 11,500 at the end of 2023.
We're at 9,000 right now.
We're through 9K
Mike
in the last day.
emailed me how to get the LME quotes because I didn't know how to get LME quotes, and McKee's helping me.
I think it's LMC
LME
AD S03. Is that right?
Yeah, whatever. But the screen for dummies like me is LME Go.
That's right.
It's really
still right.
important.
Just double check that.
It's a running joke, but we're not de-emphasizing commodities right now. Will Kennedy's going to join us here in a moment. She flew in from Mexico City, BOAC, yesterday, and she could land. Anne-Marie Horton joins us with the president of Mexico City, landed down at Dulles National, whatever, and joins us from her studio in Washington. How antiquated is the FAA, Anne-Marie Horton, and can they improve its budget given the budget frugality of a group of Republicans?
Well, just to also set the record straight, Tom, I was able to get home. I did suffer a little bit of a delay, but my photographer is still stuck at a hotel very close to the Mexican City airport because he was delayed because of this chaos of the FAA.
Make jokes.
So
it's not funny.
it didn't just affect domestic flights. There was roll-on effects for some of these international flights as well. Well, we should point out that in April, the FAA came out with a statement talking about the fact that they were going to begin receiving and using $1 billion of the $5 billion that was allocated to them from the hard infrastructure plan. But you bring up a point, Tom, that many people have criticized the transportation industry in general, is that they don't have enough funding. We've spoken to sources on background talking about the fact that some of the technology that had to deal with this shutdown in one of these databases is just antiquated. So there's a lot of law, but this is going to become very political because the fact that Pete Buttigieg, the Secretary of Transportation, is very much so potentially on the short list or bench for a future presidential candidate for the Democrats.
The bottom line is, whatever anybody's political persuasion, there's a mist of frugality across Capitol Hill. So there's a fire at the FAA. We got to throw money at it. There'll be something 2 weeks from now. We got to throw money at it. How do we develop a frugality demanded by certain Republicans?
Well, the point I was making earlier is that they are receiving new funding from the hard infrastructure plan that was supported by both Democrats and Republicans. And they talked about last year that they are starting to use that funding already. This is everything from technology to also restoring some towers to, across the entire industry. So there is money that is flowing into the FAA.
See how she gave it to me there, just like Bramwell?
Big time.
Like, we're not even missing Bramwell. We got Anne-Marie.
But you missed the punchline.
Just
AMH travels with a photographer.
Yeah.
Did you know that?
Well, I don't.
When did AMH travel with a photographer?
Guy, like Al Franken years ago at the
cameraman.
conventions.
How do you think I got on TV?
Big boob. She's running around.
He's a cameraman. As in, okay. But I thought she referred to him as a photographer.
She's got a whole
Matt Tomlin, well, he's both. He's really
he takes photos of you too. Wonderful. We need to go around with photographers.
We do. You know her dog that she travels with? She's got a waiver to take a dog with her.
I didn't know that.
Yeah, the dog's name is Bellman. It's incredible.
And travels with her.
Yeah.
Down to Mexico. Yeah. Unbelievable.
Bellman, sit here.
AMH, let's get serious. Classified documents. The President of the United States. The former President of the United States. Where's this going?
Well, this is going to create a lot more headaches for the Biden administration because first reported by NBC News yesterday is that they found a second set in a new location of classified documents. And the questions facing the president now is on the first set, specifically on why was the press only issued a statement after CBS News broke this report, and what is in those classified documents. And this is something that the press secretary yesterday really did not want to answer. Now, on the heels of all those questions, they have to answer what is in this set of new documents, where were they, and how were they handled. And obviously, everyone in Washington on the GOP side is drawing parallels to what we saw with the prior president and his classified documents at Mar-a-Lago. Obviously, facts are facts. There are some differences between these two issues, but the president is going to face criticism for potentially being hypocritical in his remarks about the former president.
Well, bringing up his words that he used for the former president about the same thing, which is that the former president was, quote, totally irresponsible. To your point, Anne-Marie, there are some important differences here. We won't explore them right now, but I think a lot of people wondering the same thing. Why does this keep happening?
It's a great question. You know, I don't really know why this keeps happening. I think with the former president, you know, the differences is obviously his lawyers signed off that there were no documents, government documents or classified documents at Mar-a-Lago. That was a false. There was a subpoena. There was a search and seize. There was classified, including top secrets, and then hundreds of other government documents. With the Biden administration, unsure why the president had these documents. They were from his time when he was vice president. They were in his private office when he left. But what we do know is that when they were found, they were immediately given to the National Archives. The National Archives were alerted, and his lawyers have been handling it since then. But it's a great question. How does this happen? How is there no procedure at the end of a term to make sure that everything is accounted for and is not being leaving Pennsylvania Avenue?
Absolutely bizarre. Fantastic to catch up with you, Anne-Marie, as always. MH, welcome back to Washington. Anne-Marie there. This on Twitter. I guess someone's got to take the pics for IG. For Instagram.
Got that right.
Is that why she travels with a photographer?
Yeah, Francine is a photographer too.
Does she? I didn't know that.
Oh, yeah,
I did not know that.
Huge on Instagram.
We've been missing out on that, haven't we? Have you even got an account? I don't have an account.
No, I mean, they cut my entourage back. I'm down to 7 people. You know, they cut it back. I had 9.
I saved the handle on Instagram a long time ago, so I have the Ferro TV handle. I've just done absolutely nothing with it.
Do we have Jordan Rochester today?
We should catch up with him.
Do we?
I'm not sure we do. Over at Nomura.
He just
116
stunning
euro
call
dollar
on Euro Swissy.
On Swissy as well.
More of a Eurocentric call. This is inside baseball, folks. But this goes to the inflation ramifications of Spain, France, the United States, Japan, China. This is a global inflation Thursday. And I'm sorry, he's got a jump condition call out to a weaker Swiss franc, stronger euro. 104 is the number for those keeping score. But that's a big move.
Short-term call 110. Long-term call into year-end 116 for euro dollar anyway.
Yeah. For euro dollar, it's different.
Saw Jordan published this morning. The president speaks later. It's curious, isn't it? Yeah, 8:30 Eastern time we get a CPI report. Then 10 Eastern we hear from the president of the United States talking about the economy. You think they're expecting some good news here?
They got. Come on, I don't know the politics on this. I seriously, folks, I don't know the process, but they gotta already have the numbers. I mean, the CEA. Heather Boucher and the rest of them, they have to have the numbers.
McKee will confirm that. We'll have a chat with Mike a little bit later.
We're going to have a couple chats with Mike.
About Supercore. We'll talk to Michael Pond about Supercore as well. Head of inflation-linked research at Barclays. Timely guest. Coming up shortly.
Michael Pond.
Coming up next, very cool. Equity futures right now, unchanged on the S&P. Bonds not doing much, 352.98. And crude, 78.33. Positive 1.2%. Tom mentioned that Rochester call over at Nomura on Euro Swissy. Euro dollar, he thinks next stop here. By the end of the quarter, 110, 107.61 right now.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Two hours away from CPI data in America.
2 hours, 22 seconds.
Is that right? You counting down? Equity futures look like this on the S&P. Equity futures totally unchanged after a couple of days of gains on the S&P 500 over the last 2 days. Gains of about 2%. In the equity market on the Nasdaq, we're down about 1/10%. No real drama there. 2s, 10s and 30s in the bond market look a little something like this. Your 2-year up almost a basis point to 4.23 on a 10-year, down to about 3.53. In the FX market, we mentioned Jordan Rochester of Nomura about 5 minutes ago. He said this: expect better European data, inflows, terms of trade, falling US CPI, and more to boost euro-dollar towards 110 in short order, with 116 by year-end now in mind. Euro-dollar right now, 107.63. The big move you're seeing this morning, though, is dollar-yen. A local news report suggesting there might be a policy review at the BOJ as soon as next week. Tom, you mentioned that City call, that they might drop yield curve control pretty quickly.
Amy, you got that board on that? Let's try to get this up right now. Amy's in the control room trying to keep track of the countdown clock, and maybe we can get up the Citi board. These are the two heavyweights in Tokyo with Citigroup, and they put out a blistering note in the last 90 minutes, and it's real simple. They look for the yield curve control to be taken care of now. John, the major thrust of their note is let's get out front and get this fixed now before the next BOJ leadership.
Will we see a test of this Japanese government bond market, Tom? I'm looking at JGBs right now, the 10-year, just short of 50 basis points today. 0.4999%. It's right there, bumping up against it.
To collate our punditry, they're looking for 115. So that's sort of the mixture, I would say, from a 150 down to a strong yen 150. Let's look at the Citigroup comment. This is a bold statement. Mike McKee says they're catching up with others. We expect YCC to be abolished. BOJ meeting coming up here in a bit, comparing the impact of abolishing yield curve control under Kuroda and under the next governor. We think the former would cause less damage. This is a very negative report. Less damage now versus more damage later. We believe it unlikely that inflation or wage growth will rise sufficiently or sustainably enough to prompt additional policy adjustments. So they're looking at a measured path here, but let's go. And that means weak dollar, strong yen.
So it's only back in December we were talking about a more sustainable policy set up by the BOJ, and that's why they adjusted their yield curve control. First, just lifted the band up, and we're going to adjust it again a month later.
Yes, we're going to adjust.
Just like that.
Well, but the adjustment failed. That's what the observation.
I still remember a conversation I had a long, long time ago, years ago, about central banking, and I won't mention the person who said this to me.
Was it Michael Pine?
I said, "What makes a good central banker?" And do you know what they said to me? Someone who's good at lying. Someone who's good at lying was the answer.
You're going to get in trouble.
You know,
we're going to de-emphasize.
We're going to
de-emphasize your interviews with central bankers.
If we're going to talk about yield curve control on a sustainable path, and then a month later talking about it getting dropped, I can't keep up.
What do you got, John?
I've got 1 hour and 57 minutes and 16 seconds away, Tom, from the CPI report. being seen as the key data point for the Fed's way forward. This is what Michael Pond of Barclays has got to say about it. Given the momentum in economic activity, the very tight labour market and still unacceptably high inflation, we continue to expect the FOMC to further raise the Fed funds target range at the February and March meetings, Tom, and to stay on hold in Q2 and Q3.
This is a treat for Global Wall Street on this incredibly important day. Push the jokes aside. This is really serious for Global Wall Street. And they turn at Barclays to the guy definitive on the global sense of full faith and credit, debt, and inflation. He is Michael Bond, head of global inflation-linked research at Barclays, which barely describes a competency. Which part of the linkage of inflation to your linkage of yield analysis, which part matters this morning?
Tom, it's all about wages. In the spring of last year, the Fed started to lose control of inflation. It kept saying, oh, it's transitory, it's going to come down, and it basically gave up on its forecasting ability. Historically, though, the Fed ran monetary policy based on a Phillips curve, wage-driven inflation approach. And they've essentially gone back to that. So really, it's the labor market that almost matters more than today's inflation report. But the Fed is now focused on the sliver of CPI that is wage sensitive. So get rid of core goods, get rid of energy prices, get rid of anything that's not attached to wages. That's still high, and that's going to keep the Fed home.
Michael Bond, this is what Global Wall Street wants to know. I brought it up with George Congalvis before. It's going to come up all morning, including with Vincent Reinhart, the expert in economics, later. Michael Bond, do you aggregate the information this morning? Or are you going to slice and dice it in your strategy forward for fixed income?
Absolutely, because we're going to look at the components that give us information going forward. So, for example, the shelter component, which is 40% of core CPI. So it's really important. Because of lags, that's likely to be very strong in today's report and perhaps in the next several months. But we know from incoming data on rents that the rental market has almost cratered. A lot of series that we see on private rent series have basically shown zero rent inflation over the next several months. So if you slice and dice the CPI data into what gives you forward-looking information, that's what's going to matter to the Fed. The Fed thinks that the forward-looking information is all about wages.
John, this is critical because you and I are biased by New York City. The rest of this nation isn't what we're living on, Manhattan.
Oh, totally agree. Totally agree. And to pick up on something Michael's been saying, Michael, it's only a few months ago, not so long ago at all, the Chairman Powell implied there was no space for nuance here. Why all the nuance now?
Well, again, you talk about what makes a good central banker. I think what makes a good central banker is patience and consistency. The Fed has been incredibly patient and consistent since the Jackson Hole speech, which was very hawkish. The market wants to hear a dovish pivot from the Fed. With every piece of data, the market looks at the most dovish piece of information. So in the employment report, it dismissed the drop in the unemployment rate and instead focused on the modestly softer average hourly earnings growth. In today's report, the market again is looking for a dovish pivot from the Fed, but the Fed is consistent here. We think that keeps them hawkish.
Is that a problem, Michael, do you think, for Chairman Powell?
We don't think so because, again, the Fed is a risk manager, right? If a year from now inflation is too high, and inflation expectations are too high, the Fed will see it as a policy mistake. If instead we have a modest recession, but inflation comes down and inflation expectations seem low because they overdid it, that's going to be a win for the Fed.
Mike, in your world, do you have a conviction to go long, short, long duration, zero coupon bonds? Is this a point where Michael Pond's out in Vegas betting on interest rate direction?
Not yet from a nominal perspective, and it's because, again, as you were saying, you really have to break it down into the real and inflation components. Inflation as priced by the market is already very low and not likely to go much lower unless things really deteriorate on the economy. Real yields, though, are fairly elevated. In the front end, we have forward real yields at around 2%. That's very restrictive policy, and not just in the next couple of quarters, but even deep into next year. So we think that there is scope for real yields to go down, but nominal rallies might be challenged by already low inflation expectations.
Where are we a year from now on the 10-year yield? People's heads are spinning at home. You got them way going. You're all Fabozzi this morning, Michael. Stop it. Where's the 10-year yield in 12 months?
I think there's certainly scope for it to move down further, particularly if we get a recession as we're expected. I'm not going to put a specific number on that, but again, a deeper recession could bring us back inside of 2%.
Michael Ponder, Barclays, there's a call to get inside 2% potentially. Michael, thank you, sir. Wonderful to catch up with you over at Barclays. If you're interested in some of the estimates right now, the median estimate in our survey at the moment, so this is headline inflation year over year, which always makes the front page of the newspapers, you know that. CPI year over year, the estimate's 6.5% from a previous month, which read 7.1%. The numbers this morning for the month of December. So if you take out food and energy, Tom, month over month core, which will be our first look this morning, I'm sure, 0.3% the estimate, 0.2% the previous month. Then Mike McKee's going to break it down for us, strip out, shout to get to all that nuance and all that good stuff people are obsessing over at the moment.
Well, for people like me that don't obsess over all the numbers, the answer is the adults like McKee are looking at month over month right now. The dynamic there is so important. One thing I'm comfortable with, folks, is not month over month, but year over year, but the 3 month and then annualize it. So take 90 days of data and then pretend it's a year long. And those lead to some really interesting charts.
Do we think these trends have become entrenched? These more recent trends have become entrenched?
You can say goods have reverted to in the vicinity of where they were December 19. Services have not. There's a little bit of an ebb in services. On radio, I'm moving my hand.
It's very effective.
We're de-emphasizing hand signals because
why is that?
Radio's complaining, you know.
Hand signals.
You know, they got a hate mail from Anthony from Sparta. He was vicious.
Well, if you grow up in an Italian household, you're very expressive.
Yeah,
Tom.
he is.
You know, I learned how to use my hands. Just became very expressive as a child.
Yeah,
AMH the same thing.
It looks like you're landing airplanes on TV.
You throw your hands around.
You know,
you just get used to that.
I grew up in state, and I'm like, my hands are in here. Don't leave your hands.
What, like that?
Yeah, you're very.
No, we weren't like no. The first hand signal you learned as a child was that. Never followed through, but that was enough.
You know what? You'd be pleased with the LME guy. We used to quote gold at the Keene House off Spot Gold London.
Oh, really?
Yes.
Why was that?
It goes back, I don't know, great grandpa, who the hell knows?
Did they quote the LME as well? Just more broadly for things like copper, metals?
I remember the day Nixon took us off the gold standard. I remember there was a lot of yelling and screaming there.
At home?
Yeah, the floor buckled upstairs. My mother had so many Kruger-ins.
My granddad used to have them too.
Yeah. I mean, let me tell you, her Kruger-ins worked out a lot better than my controlled data.
If they're out there at the moment, I'd love some, if anyone wants to send them in.
Please send
Tom, I'm told we're 1 hour, 49 minutes and 16 seconds away from this CPI report.
It's a super core inflation.
I'll keep us up to speed.
Brought to you by Patek.
Is that right? Is that right? Lena Miller's coming up, the CEO of the China Beige Book. Looking forward to that conversation. Where are we with China and this reopening, Tom? Where does this demand show up? How quickly does it snap back in?
We got a huge pressure to talk about the United States today, but this is serious. And there's a lot of notes about an imputed inflation already in China, which gets up. One shop had a red line of 3%, and they're getting there fast.
Does this disrupt some of those trends we're seeing in the US CPI report? You talked about goods disinflation becoming entrenched, maybe.
Yeah,
we'll see.
I believe they're, independent. Somebody's just emailing in and whisper CPI.
What's that? Let's just like the guest going into it.
McKee's on his phone. McKee sits somewhere near me between my entourage and him, and McKee's on the phone.
What's whispering? Who's he whispering to?
I don't know.
Just to be clear here, Mike McKee does not have the inflation report. Okay, 8:30 Eastern Time, which is an hour and 48 minutes away. We will get the inflation report. And then after that, you'll hear from the President of the United States at 10 a.m. Eastern Time, so 90 minutes later.
They held the price on Tang, no inflation there.
Yeah, from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, as you've been hearing, traders are betting that U.S. inflation is cooling. Now, that would reduce pressure for aggressive rate hikes from the Federal Reserve. We'll get the latest consumer price index at 8:30 New York time. The projected 5.7% increase would be well above the Fed's goal, but the year-over-year price growth would also show moderation. The U.S. and Japan are taking steps to counter the growing challenge posed by China and its ties with Russia. They announced plans to strengthen defense cooperation on land, at sea, and in space. The U.S. plans to reorganize its forces in Japan so it can deter and respond better to increasing regional threats. China hasn't updated its daily COVID report for 3 days. Now that's adding to global concerns that Beijing is masking the true impact of the world's largest outbreak. The World Health Organization has renewed its call for more COVID data from China. And Bloomberg's learned that the corrupted file led to the breakdown of an air safety system that prompted flights to be grounded across the U.S. Both the system that provides critical information to pilots and its backup failed. Almost 10,000 flights were delayed. Bloomberg's learned that T-Mobile may buy the budget wireless carrier backed by Ryan Reynolds. Now it's called Mint Mobile. The second largest U.S. mobile service provider has been in talks with Mint, but no final decision has been made. Reynolds owns about 1/4 of the company. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
For last year for the global economy to be weak. Now I think there's the markets are signaling that the plunge in natural gas prices in Europe suggests that Europe may not have a recession after all. And now with China abandoning the COVID policy, opening up, there's a perception that we may get a terrible wave of the pandemic for a few months, but then it should abate and China should open. So the outlook for the world economy, I think, is actually improving.
Can you hear that? Cracks in the consensus and the outlook. All of a sudden, people getting more and more constructive about the outlook here off the back of that China reopening story.
Yardeni's been way out front for the last 6 months. He said, everybody calm down.
Ed Yardeni there, of Yardeni Research. Not the only one. Julian Emanuel, the Chief Equity and Quantitative Strategy Overist at Evercore ISI, on Tuesday announcing quite the call from his firm on China GDP.
We think there's a very good case to be made for China assets right now. In fact, our China strategist, Neo Wang, thinks we get to 6.2% GDP growth.
6.2%. 6.2%. Tom, 6.2%. That is just phenomenal.
It is a phenomenal number, and it's what we do as we did with Michael Pond on inflation. We want you to speak to an expert. Out of Virginia, he's really something. Leland Miller, John, with China Beige Book, and you look at Leland Miller, folks, and you say, well, what's so special about him? He has a granularity on China like no one. He framed 6.2% GDP this morning. Leland, what do you do when you hear 6.2% GDP from some competent people like Ed Hyman? How do you react to that in China?
I think that you could get some extremely high numbers of GDP next year, but it's based on the idea that you're not just going to have the cyclical bounce back, which we expect, which is, firms restarting investment after COVID-0's pullback, consumers jumping back in, albeit temporarily, getting the pop off of 2022's very low basis, statistical basis. But in addition to that, in order to hit 6.2, you're going to have them layer on stimulus.
Yeah,
it could happen. You're seeing headlines about stimulus, but you have to expect them to be doing all these things at once. So it could happen, but it's much too early to be guessing that with any type of clarity.
To your expertise, like folks, the electrical grid from Shanghai out to the west, Leland Miller, if they impute a fiscal policy, can they diffuse that stimulus faster because of the power of the government, the totalitarian regime?
It depends on what kind. This is the question of 2023. And we just built a proprietary fiscal stimulus index to be able to track the flows that are going into fiscal spending. We have a fiscal activity index to see what's actually happening. And what's happened in December, for instance, is they're pumping money in and absolutely nothing happened. The activity index fell off a cliff. So it doesn't, just because you see a stimulus headline doesn't mean it's being worked into the economy. So that's the real problem with 2023. Are we going to actually see these big headline numbers and even some of this easing that we see more broadly? Will it translate into activity?
How does this economic discussion translate to the medical discussion the nation faces right now?
Well, Beijing's doing their best to pretend that COVID-0 is going to be a blip for a month or two, and then they're on their way. And to some degree this will happen, but I think that the fact that they're acknowledging virtually no deaths, and most people are thinking they're going to see 1 million deaths, you have to understand there's going to be a cascading effect through the rest of the year. It doesn't mean you're not going to see a nice cyclical bounce back. It doesn't mean that Chinese assets aren't going to rally like crazy for a while. It just means that this is not something where you can dive into, dive out of, and have no effect in the middle. And you also have the possibility that later on in the year, you have another problem with COVID. So there's a lot of potential risks here that are getting camouflaged by people's optimism over the fact that the middle of the year should look quite good.
Leland, the China that's reopening is not the China that's shut down. There is an argument from many that perhaps this consumer, the Chinese consumer, is a little bit more nationalistic. Leland, we're trying to work out where this demand actually shows up, kicks in. Does it go abroad? Do people travel to Canada, Vancouver, try and buy property like they tried to before? Trudeau's trying to stop that. Governor DeSantis is trying to do the same thing in Florida. How do you think this is going to pan out?
Yeah, there's been this idea that just because Chinese consumers haven't spent for a while, that they're going to take their money, they're going to run out of the country, and they're going to spread it around the world. This has never really been the way it works. Chinese travelers used to spend a lot of money abroad. They're not buying a lot from abroad, but I think even the travel parts have to be moderated right now. People are seeing the relatives domestically for the first time in 3 years. Plane ticket prices are through the roof. There's just a lot of guessing people are doing in terms of skyrocketing travels coming back and skyrocketing this is coming back, and China's going to guide us into the next stage of global consumption. This has never been true. So I think we need to be very, very cautious on assuming Chinese consumers are going to do anything for the world.
Leland, just one final question from me as well. I think we're all trying to work out how much bad data we'll have to look through in the near term, and for how long, which basically is what you're touching on at the moment, Leland. How quickly do you think this will snap back in, and we'll start to see that good stuff in the future?
Well, look, I think Q1 is going to be a mess. The second quarter is when you'll see a reactivation of the economy, and you're going off, very low 2022 numbers. So people could be very, very pleased with the bounce they're seeing the middle of the year. The key part is this could be a head fake, because maybe you see 3-4 quarters of growth pop back up. You're still in the midst of a long-term structural slowdown. So for the next, for most of 2023, people are going to be talking about the cyclical uptick. But then after that, as we get towards the end of the year, we're going to start re-talking about the structural slowdown, which is going in the other direction.
Leland Miller there, the CEO of China Beige-Book, one of the best. Leland, just fantastic as always, sir. Thank you. TK, you heard it there. Trouble in the near term, very, very short term. You get through the messy Q1, snaps back in, really strong growth through the rest of this year, and then You have to deal with those structural challenges that still exist in that economy.
Their political challenge is at the margin, employ people. And the outro on that has always been state-owned enterprises and secondarily real estate. Within all that wonderful discussion and very informative discussion, I wonder what I'm speaking here from a distance, the pseudo-fiscal impulse will be to bail out once again the commercial and residential, the apartment real estate, the city building real estate.
Well, I wonder if residential picks back up again in China. As I say, the China that's shut down is not the China that's reopening. And China reopens with lower rates in a way that maybe the rest of the world is facing higher rates. China doesn't have that, Tom. And maybe they have a bit more capacity to support the economy. So we're slamming the brakes abroad, and over there they've been doing something else.
And on a broader scale of 10 or 20 years, we're become addicted to a 5, 6, 7% China GDP. Are they going through this process to reset? And I'll let you pick 3 or 4% GDP. You know, John, with the COVID, we've de-emphasized our coverage of Pacific Rim. But I can see Yumi and Bramo in Shanghai.
You want to go to Shanghai?
Yeah, I think, on the Bund, the Peace Hotel, looking down the Bund and get the pulse there. We have Leland Miller over and,
you picked the bar out already? Is that where this is going?
Can come up from Hong Kong and we can listen to some jazz at the Peace Hotel. And,
okay. Can you go? I mean, I'll give it a miss. And you go.
No, I think you should attend. I think the reopening of China is a surveillance story.
A surveillance special?
It's a surveillance. Okay. No, not a special. It's a weak commitment.
Are there family members that you'd like to see and
no,
like to expense that? You were telling us earlier how expensive those flights cost.
They'll hold the lamps. I am mounting $34,000 business class.
That is ridiculous. I mean, come on, that's
where we are right now.
Seriously?
Yes, that's what came up on the screen.
That is insanity.
Mr. Kirby, I saw that on your website 2-3 days ago.
Is that like a month away, a week away?
No.
How soon was that flight?
3 months out, and then it went away. It disappeared because probably we mentioned it.
Okay, I'm going to have a look at that in a moment. Yeah, okay, let's get you set up for inflation. We're counting you down. Where's that clock? 1 hour, 35 minutes, 15 seconds. I'm just doing that to wind you up. Futures unchanged on the S&P going into this. 8:30 Eastern time is when you get that CPI report. The president speaking 90 minutes after that. Bit of Fed speak today as well. You'll hear from a number of speakers, including Tom, Harker, Bullard, Barkin. All talking. I know you like to follow Bullard. He'll be speaking a little bit later.
Well, no, I like to follow all of them. What I'm really interested in there is Harkin. I think that he's got a real grasp on business activity. They're all different and unique as well. Where's stagflation? What happened to stagflation?
It's not over yet. It's not over yet.
Well, we're living it.
You get 5%. Look at the forecast from the World Bank.